platform. I just had to use this platform to tell you guys because I cannot begin to start telling everybody, oh, it's not, send it to the group, send it to the group, so that it won't look as if, oh, I'm not responding to my messages or Mr. Ibrahim is not responding to his own messages. It's stressful. It's stressful. So please, I beg, please. I know it's not easy. We are all trying. You are trying. I am trying. But please, cut some slacks for us, please. Please. If you have questions, send it to the group. We will attend to it when we see it. And even if we don't, some other people will do. They will do. We will ask your questions as long as it's educative and it's relating to SFM and all what of that. We will respond to it. Please and please. Thank you very, very much. I'm grateful. Thank you. Mr. Ibrahim, thank you very much, sir.
Okay, thank you so much, Christy, for that. Right, and I just want to use this opportunity as well to appreciate your good work. Thank you so much for that. So thank you, Christy. Okay, please can someone give us an overview of what we discussed in our previous class? Please can someone give us an overview of what we discussed in our previous class? Before we move ahead, please. Or should I call him? Can someone give us an overview of what we discussed in our previous class? Okay, I think I need to call names, right? Okay, I think I need. Okay, Chindima Esther. I mean Esther, right? Esther, are you there?
I'm here. Oh, sorry, I've not been attending the class. I've not been feeling fine.
Okay, that's fine. Esther 2, second Esther. Um,
Okay, good morning, sir.
Good morning. Good morning. So, can you give us an overview of what we discussed in our previous class, please?
Okay, we talked about free cash flow and is a method of valuation, is the amount of cash, is the amount remaining in for an organization. So is the amount of cash available for an organization, and we talked about we have the free cash flow to equity and the free cash flow to the firm. And we said the free cash flow to equity, we use the cost of equity to value it, and it does not consider interest in calculating the formula for calculating it, and also borrowing or anything that relates to debt is taken away from it. And for the free cash flow to the firm, we use the WACC to discount it. And it's also free cash flow to the firm, as at times they are being ranked to they they go down to infinity. That is for business valuation, they value down to infinity and the rest. That's all I can say for now.
Okay, thank you so much for that summary. I think I still need someone to explain more. Thank you so much, Esther, for that. Um, okay, Madam Sonia, are you there? Are you there? Okay, Fumilayo. Fumi, please, can you just give us an overview of what we discussed in our previous class? Okay, Fumi, are you still with us? Okay, that's fine. Fatai. Fatai, are you there? Wale. Okay, Wale is not. Kende, are you there? Hello, Kende.
Good morning, Mr. Ibrahim.
Yeah, good morning.
Can I just add to what the other person said earlier?
Please go ahead.
Okay. As she said earlier, that last class we treated free cash flows. And you told us we have two types of free cash flows: the free cash flows to the firm, the free cash flow to equity. Then you gave us the format for the two free cash flows. Then you said the free cash flow to the firm, they are the cash flows that are available to the company suppliers. Okay. Then you also told us that this type of free cash flow, that's the free cash flow to the firm, we use WACC, cost of capital, to discount it for it. Then you also added that in case where the examiner is trying to test the risk adjusted cost of capital, we will use the appropriate cost of capital to discount it. That's the free cash flow to the firm. Then you also told us about the working capital. You said working capital is current asset minus current liabilities. Then you will move to the free cash flow to equity. Here, what I just want to say is just that you also told us that when we are dealing with free cash flow to equity, this is the equity for the shareholders of the company. So it represents the potential dividend that the company can pay to its shareholders. So here you said the difference between the free cash flow to equity and the free cash flow to the firm is that the free cash flow to equity has debt in the formula. It has debt in it. Then what else? What else? Okay, you also said we'll use cost of equity to discount the free cash flow to equity using CAPM or dividend valuation method. Then we also treated an illustration. I think that is what I have here.
Okay.
Thank you.
Yeah. Thank you so much for the summary. Right. It makes sense. Right. Thank you so much. And I think you forgot one part. You forgot to add that the working capital, the current asset minus current asset in calculation, then exclude cash, cash and bank, as well as short-term investment and dividend, because the short-term investments are for capital structure, right? Short-term investments are for financing, not operational, right? So why the cash and cash equivalent will be like when you add it to your current asset, it is like double counting, right? You're adding it twice because what form part of your cash is your inventory, because you convert your inventory to cash. So that is the reason why it is excluded in the calculation of working capital. However, the part of what is it called, the dividend payment. Dividend payment is not actually part of operation as well, so is also excluded in the calculation of working capital. Thank you so much for that summary. Now, in today's class, we'll start with business valuation. Class, free cash flow is a form of valuation. Then we have to move further. We will keep on talking about, we'll keep talking about free cash flow, even when we get to merger and acquisition. Class. Now, why do we have to value the business? Why do we have to carry out evaluation of a business? And that is the first, I will start my discussion from that. Because the examiner may ask you that, what are the reasons for valuation of a business? Plus, companies analysts carry out evaluation of a business for several purposes. Plus, one, to be able to, please, you can check your drive. I've sent the material just now. Right, you see free cash flow and valuation. You can check the drive. Right, you can check the drive. Thank you. Now, reasons or purpose of valuation of business. Now, to be able to make share purchases or sale decision. Plus, when you want to buy a shares, you don't just go because Kennedy has shares with Fidelity. Let me go and buy shares. And recently now, right, I think now, is it Zenith? I got a notification that I think it's Zenith Bank or Stanbic is now paying what we call an interim dividend. We'll get there. That is what we call signaling, right, under dividend policy. I've equally sent, if you check the drive, you see dividend policies there. Please, all those notes, you have to read them up, right? Now, when you buy shares, when you want to make shares purchase or buy shares, you have to carry out a valuation. You don't just go to the market, to any stockbrokers and say, okay, let me just buy shares because the market price is low, and that is it's a free entry whereby it's good to buy, right? It's worth buying. No, it is not done that way. You have to carry out a valuation of a business. So that valuation of a business will now give you what they call either an upside potential in valuation in financial modeling. You can say, oh, either upside potential or a downside potential. Now, when you look at it, that okay, this gives an what is it called? Upside potential of 2% or 20%. So what does that indicate? It indicates that, oh, maybe in the next 5 months, or in the next 6 months, or in the next 6 years, or in the next 55 months or years, this will be your return. That is an upside evaluation. That is an upside what? Upside potential. At the same time, so that means that you look at it that, oh, this will be your what? Return at the end of the period. So quickly do what? Quickly go and buy, right? Why do you have to buy the shares, right? Then you've carried out the valuation that you have an upside potential of 20% or of 3 or 40 kobo per share. Then you look at it, what is the current market price? You have a current market price of 20 naira per share, plus of 20 naira per share, plus the valuation you carried out shows that the future value of the company, which is the intrinsic value of the company, will be 40 naira per share in the next 5 years. 40 naira per share. But the current market price is showing 20 naira per share. What it means is that the company shares has been undervalued, has been underpriced, because the intrinsic value, what is intrinsic value, is the value of the company. That is the true value of the company. The intrinsic value of a company is different from the market price of a company. Now, when you look at it that the intrinsic value is higher than the current market price, you quickly do what? You buy more of the shares, because the company stock has been underpriced or undervalued, right? At the same time, when you have a downside potential, right, whereby your intrinsic value is lower than the what? Than what is it called? Than the current stock price, right? What it means is that the stock has been what? Overpriced. overvalued. All right, so you look at it that it does not worth buying because it has already been what? Overvalued. Now, what I'm trying to explain here is that it's part of valuation. When you want to buy a shares or you want to sell a shares, you don't just go to the market and because this person buy shares with as shares is this, then you quickly go and buy. No, you have to carry out a valuation, right? Either you use free cash flow to carry out the valuation of a business, or you use other financial metrics, right? We'll get to the point of what is it called, fundamental and technical analysis, right? Now, another reasons why you have to carry out a valuation is for tax purposes, of course, because of inheritance, what's tax purpose, right? You want to know what are the accumulated tax over the years, right? So you have to carry out what? Evaluation to know the value of that particular what business, right? For divorce settlement means that if the business is not bringing anything to the table, is not making loss, it's better you liquidate the company, right? Then when you want to carry out a liquidation, right, maybe you want to liquidate the company, you have to do a valuation of the business to know the current market value of the business, right? Because that will be the minimum amount that those people who want to buy will pay for that what particular business. You have to carry out a valuation for divorce what settlement. Now, for the disposal of subsidiary, of course, when the subsidiary is not performing well, right, is not performing well, you can't dispose it, right? We see buyers who will come and say, oh, they want bidders, right? They will say, oh, they want to buy this subsidiary at this what at this current price, right? But you will be the one to do the valuation. The question is, who will be the one to even do the valuation, right? Both companies can actually carry out the valuation, because you will not want in a situation whereby the buyer will now go and undervalue the company, and at the same time, the buyer will also want to determine what to know the value that he will be willing to pay for that particular company, right? Now, then when you want to dispose subsidiaries, you have to carry out evaluation to know the value of that particular business, and there is what we call MBO, right? When we get to what is it called, reconstruction and reorganization, we talk more of demergers, we talk more of management buyout and management buying, and stock splits, right, or share split. Now, when you have management buyout means that you dispose a subsidiary to the internal management, because you don't want to take it out, you dispose it to them, but there is a reservation. What are these internal management, what are they looking at? What are they looking like? What is their position when the company is not making profit? Now, when they want to sell, you have to sell to them. So there's a reservation there that does it make sense where you have management buyout, you have to sell when you have management buyout. Management buyout means that the examiner may ask you, differentiate between management buyout and management buy-in. Management buyout means that you are selling the company, the subsidiary, to the internal management, while management buy-in is when you sell the subsidiaries to the external management, external people, right? So you carry out a valuation to determine the value of the subsidiary. Now, another reasons for valuation is to establish what merger takeoff terms, whether merger or acquisition. And we see recently between what is it called, Titan Bank and Union Bank, right? We see the kind of merger that arise. So they've before they can be able to say they want to merge, right, there must be a benefit of merger, right? We'll get there. There must be a benefit of merger, right? Either it is revenue synergy, or it is cost synergy, or financial, right? We'll get there. But when two companies want to merge together, you have to carry out evaluation to determine the value of that particular company. However, when it is acquisition as well, you have to carry out evaluation, because you want to know the minimum price that you will be willing to pay, or the maximum price, right? What is it called? The maximum price or the minimum price. There are two different things. The minimum price means that the minimum price that the target company will be willing to accept. There is a minimum price, right? While the maximum price is the price that the main company, the company who want to acquire the target company, will be willing, the highest, the maximum price that that company will be willing to pay for the what, for the acquisition, right? We'll get there when we get to merger and acquisition. Now, to value shares sold in a private company, of course, this may be let me say unrealistic to some extent, because private company who are not listed, okay, let me say unlisted company, to determine the value of unlisted company is very, very difficult to do, because their stock, their market, their stock is not traded in the what, in the stock market. So you can still value a private company who is a listed company, right? Maybe you want to sell, they want to sell the company, they have to carry out what, evaluation of a business. Now, thereafter, we need to move to what, the methods of valuation of a business. Class, we should not forget that free cash flow is a method of valuation. Economic value added ever is a method of valuation. Market value analysis is a method of valuation, right? Shareholder value analysis is a method of valuation. We still have methods, other methods of valuation, class. So when they talk about valuation of a business, right, there are different methods, forms of valuation of a business. The free cash flow is a method of valuation, is a form of valuation of a business. Economic value added is a method of, you can use it to value the business. Shareholder value analysis as well is a method of valuation of a business, right? EBITDA multipliers and all that, they are also valuation techniques, right? Now, we have methods of valuation, class. There is asset base, because for like, I think for like 2 diets like that, I think May 2024, is it May 2024? Yes, I think May 2024, right? I can't actually, the institute actually tested question on the method of value, the asset base, the income base, and dividend, and like that. But after that period, after that May 2024, the question we've been seeing on valuation of a business, even merger and acquisition, is a form of valuation of it, because when a company wants to merge, you have to carry out evaluation. When company A wants to acquire company B, you have to carry out evaluation, right? So we'll still keep on, when we get to merger and acquisition, it's still a form of what? Valuation. It's now the examiner will now state it that, oh, use free cash flow, use asset base, use economic value added, use shareholder value analysis to value the what? To value the business, right? Now, the asset-based class, and after May 2024, if you look at, we check November 2024, the questions are actually different. I think from May 2023, question 1, May 2020, November 2023, question 1, May 2024, right? May 2024 is actually tested the question on asset based. Then November 2025, it becomes share to share. It becomes where you have to determine what is it called, the percentage gain after post acquisition and all that, right? Then we check what play out in May 2025. May 2025, we see you have to calculate the value of before the merger, then after the demerger, you compare it, whether it is good or not, and all that. So we could see what is happening, what's the trend of the question on valuation, and what will be the basis. What are we expecting this November? What is the expectation? There are so many expectations on the valuation of a business that they are even yet to test that part. Right, we'll get there. Now, the asset based is like an historical based method, right? The examiner may ask you, may tell you to calculate that using the asset-based method or using the historical, realizable, and the replacement cost method determine the market price of the company. Class, when anytime, any day you want to carry out a valuation of a business, maybe using the asset-based method, right? All that you want to calculate is to determine the market value of that company or the market price. That is what they need you to calculate, whether using the asset base or any time you want to determine, you want to carry out a valuation of a business, what you want to determine is the market price or the market value of the company, right? Now, under the asset-based method, there is historical cost approach, right? Now, you and I can agree with me that historical cost, Kende, you have a business, right? And Bashirat want to acquire that business. Now, when Bashirat want to acquire the business, Bashirat now presents asset base, particularly historical cost, as a form of valuation of a business. Will you accept that? So you are telling me that when you want to determine the value of my own business, you have to use historical costs, not considering the time value of money, not considering the current cost of that asset. Is that, will it show the true picture of that valuation? No. And one of the disadvantage of using the historical cost method under the asset base, it is not realistic and it does not consider the time value of money, because the examiner may ask you what are the advantages and disadvantages of using the historical cost approach, right? You can use it to, I won't accept it. What is this? You can use historical cost. So you are telling me that the assets that are worth 1 million today, you are going to value it. You value it based on the previous cost I used to buy the asset. No. That is it. Right? Now, another method under the asset-based method is realizable or liquidation. When a company want to liquidate, right, they have to revalue their assets, right? Or it is not even revalued. They have to know the current realizable amount of that particular asset, right? And the truth is, even if a company wants to liquidate, they have to carry out a valuation. Even if the cost of the asset is 50,000 class, because of, I already know that this company wants to liquidate, right? I may price it down to be, it's 50 million, or I can say, oh, I will pay 10 million. You can see that that 10 million is the realizable amount on that particular asset. It has been underpriced. As well, it does not show the true picture of valuation of a business, because there is under in real estate, right? In real estate valuation, right? They have what is it called? Forced to sell. Under the real estate valuation, forced to sell. Whereby the owner does not have choice. You just have to accept the value. Just have to accept it, because it is forced to sell. The owner, they want to liquidate, they need money to settle their debt. It does not show the true picture of valuation of a business. Class, doesn't. Right. Now, another method under the asset-based is replacement cost. What is the replacement cost of that particular asset? However, it does not show the true value of what? Of an entity using the replacement cost. Plus, the asset-based method generally is not practically, you can use it to value a business, right? But theoretically, you can use it, you can just calculate the value of the what of the company. And what do you want to achieve? Is to determine the market price or the value of the company. You want to know what is the current price, what is the not the current, what is the market price of that company, which is different from the current stock market price. It's actually different. The stock market price is different from when you are carrying out the valuation of a business. Class. So any of this method can be used. And what did you want to calculate? You want to determine the market price or the market value. Now, the question now is, how will you determine the market price? Right? Any of this method is total assets minus total liabilities. We give net assets. Is that also? We give net assets divided by the numbers of shares. It gives us what? The market price. Why the market value? If you do total asset minus total liabilities, you have the market value. That will be the market value of the company, right? Or when you have your market price per share, you can times it by the numbers of shares. We give you the market value of that company. So whichever method you want to use, the examiner asks you to calculate using the asset base, sometimes the examiner may even silent about either it is historical or realizable or replacement cost. The examiner will just say, oh, using the asset base, but from the question, when you will now see, oh, they revalued the asset, right? Maybe why did you want to revalue your asset, right? It's because you want to know the current price. You want to, it could be because of liquidation. They want to go. Everybody wants to go, right? Liquidation, divorce, right? So when you look at, oh, they may give you some replacement cost of that particular asset. So when they give you, we know that, oh, this is the method. But all in all, you have to determine the market price, and it is calculated as the total asset minus the total liabilities, which we give what? The net asset. So divided by the numbers of shares, we give the market price. So we can multiply by numbers of shares, we give what? The market value. Another method of valuation is income-based approach. Now, Warren Buffett, right, says that you can use income-based approach to value a business because the income-based approach is subjective, class. Because if you present, oh, maybe theoretically, it's theoretical, but if you present an income-based approach as a form of valuation, it's somehow to some extent, right? Because some figures in the financials, in the income statement, needs a lot of, like, we need to ask questions. How did you arrive at this? How did you do this? Why do you have this figure here and this figure here? So because it's subjective, and he said it's not you can use it to value the business, but theoretically the examiner will ask you that, oh, you should use income-based approach, right? Now, under the income-based approach, there is price earning ratio. The examiner will say, oh, using the price earning ratio, right, to determine the value per share or the market value of a company, class. So what you need to do is price earning. I now said, oh, since you want to determine the market price, okay, let's make the price earning ratio the subject of the formula, right? You can see, no, let's make market price from price earning ratio equals to market price over earnings per share. Oh, just make market price the subject of the formula, cross multiply. The formula what we need from this price earning is market price equals to price earning ratio times earning per share. We give the market price. When you get the market price per share, you can multiply by the numbers of shares to get what? The value. Now, the price earning ratio will be given to you in the question, and it is often called, they can tell you that the average P ratio, right? The average P ratio is because you can't have two unknown. You want to determine the market price. Definitely, the price earning ratio will be given to you, right? Then you multiply by the earnings per share, which gives what? the market price, or the market price. So you can multiply by the numbers of shares. We have the market value. However, if you want to determine the earnings per share, it is what? The profit after tax, right? Minus preference dividend, if it is given in the question, then divided by the numbers of shares. You have the earnings per share. However, under the methods of valuation, right? If you don't want to use the free cash flow, the discounted cash flow, which is free cash flow part of it, right? They don't use PE ratio in practice, and it's because of how subjective it is, right? Now, what they use to analyze the company's financial health is the PEG ratio. The PEG ratio is the price earnings growth ratio, price earnings growth, right? So, for the purpose of this class, when you want to determine the market price is equals to the price earning ratio times earnings per what times earnings per share. Another methods of valuation under the income based is earnings yield. So the examiner may ask you to use earnings yield to determine the value of a company. And if you look at it, earnings is accounting profit, and you can see how accounting profit is actually what subjective, right? Now, the market price equals to earnings yield. Of course, the earnings yield will be given to you in the question. Then market price equals to earnings per share divided by earnings yield. Now, the examiner normally do something here, even under the price earning ratio. Do you know what they normally do? They will give you the price earning ratio for maybe industry price earning ratio, like 3 industry price earning ratio, maybe 9.0, 2.0, 4.0. Then you now ask which one of these price earning ratio you have to use. Class, when you see in a situation like that, add all the price earning ratios together. Add all the price earning ratios together. Divide it by the numbers. If you have price industry average of 4.5, 5.2, 3.2, add everything together, divide it by the numbers, which is 3. We gives the average PE ratio. We gives what? The average PE ratio. So when you are faced with that kind of question, right, you have to add it, divide it by the numbers, right? Divide it by the numbers. Now, in another case scenario, I think one of the questions I solved for foundation skills on that FM, this earnings yield also, whereby the examiner gives the earnings yields to be 3, I think 2 or 3 thereabout, right? So what we do is that, instead of you to be confused and say, the earnings yield is supposed to be just 1 now, so that we just use it to divide the earnings per share. What you need to do is just to add the earnings yield given to you, the question divided by the numbers. You have average earnings what? Average earnings what? Yield. Now, the examiner may ask you to using the income-based approach as well to determine the dividend, to use dividend yield to determine the what? The market price. So the question is, a minute, please. Okay, so using the what? The dividend yield. Using the dividend yield. So why I have to bring this formula is because so that you know how they normally calculate it. It's not that the formula just come like that, right? You can just say, dividend yield. Make market price the subject of the formula. When you collect the light, when you cross multiply, you will have market price equals to dividend per share divided by the what? The dividend what? The dividend yield. Plus, you can see all what we've been doing since is to determine the market price of a company. And because you want to know the value of that company, you have to carry out what? You have to carry out evaluation of a what? Of a business. Now, The dividend-based approach, the dividend valuation method, you can't use a dividend valuation method to value the business that is not paying dividend, right? It has to do with a dividend-paying company, right? A company that is not paying dividend and they want to dispose that company, right? You can't use dividend valuation. You can't, because the company does not pay dividend. So how do you want to get the current dividend or the previous dividend to carry out the valuation of a business? Right? Mostly when a companies pay dividend, right, you use the dividend valuation to determine the value of that what, to determine the value of that company. Now, there is dividend without growth, right? And we have dividend with growth. Of course, we know all this under the cost of capital. So it's just for us to make this the subject of the formula, the market price. And that is one of the disadvantages of dividend valuation method. It is assumed that dividend will be constant and there will be a growth in dividend. It's an assumption. There will be a growth in dividend and the dividend will also be constant. And that is the limitation. Another limitation is that dividend valuation methods, you can use a dividend valuation method cannot be used for a company that is not actually paying dividend, because the examiner may ask you what are the advantages and disadvantages of using these methods of what? These methods of valuation of what? Of a business. Now, the dividend with growth, you have to make this subject of the formula. You have market price, the dividend, 1 plus growth rate, divided by cost of equity minus what? Minus cost of what? Minus what? Minus growth rate, which will be given to you in the what? In the question. So other valuation techniques, which is free cash flow. Of course, we've talked about free cash flow already, but we'll still keep, in as much as we are doing a valuation of a business, free cash flow will always come every time, right? Whether it is free cash flow to the equity or the free cash flow to the what? To the firm, is also a forms or the methods of valuation of a business, right? Usually they say, oh, discounted cash flow or the present value of the cash flow of anything. It can either be free cash flow to the firm or free cash flow to the what? To the equity, right? Of course, the question, the examiner, there's a place that they will point out something, whether it is free cash flow to the firm or free cash flow to the what? To the equity in the question. Now, others, there is an enterprise value. When enterprise value is usually used when you want to know the value of a company as well. So market capitalization of equity. What is market capitalization? If you go to NGS today and the market price, let's say UBA maybe is 15 naira, for instance, is 15 naira per share, right? Then you will see it where you will have what is it called? Outstanding shares, right? Total numbers of what is it called? Traded shares for that what? For that particular period. You see outstanding shares. When you multiply the outstanding shares times the current market price class, the outstanding shares, the numbers of shares times the current market price, we give what? Market capitalization, or the market value of what? Market value of equity, right? So plus the debt, plus minority interest, plus preferential dividend minus cash is also an enterprise value, is also other methods of valuation of a business, right? Then there's also EBITDA multiplier, enterprise divided by what? EBITDA. So these are all methods of valuation. Class, we should not forget that free cash flow is a method of valuation, right? Other methods of valuation they're asset-based, the income-based, and dividend valuation method. Class, merger and acquisition is also a method of valuation of a business, because when a company wants to merge or acquire another company, you have to carry out a valuation of a business, right? Then shareholder value analysis is a method of valuation of a business. Economic value added is a method of valuation of a business, of course, right? And shareholder value, economic value added, and market value added, MVA, right, is also a method of valuation of a business. So Examiner can ask you to use any of these methods to determine the value of a company, right? So before we look at an illustration, so all this explanation under the methods of valuation of a business. So please, I want you to read up the efficiency market hypothesis, because examiner will want to test your knowledge on EMH. There was a diet I can test this question, and everybody was like, what is EMH? EMH is what? That is efficiency what? Market hypothesis. An interesting topic, subtopic under the what? Under the valuation of a business, right? The examiner may want to test your knowledge on the purpose of the efficiency of market hypothesis, the weak form efficiency, the semi-strong, the strong form, as well as implication. The examiner may want to test your knowledge on it, whether you understand, differentiate between the weak form efficiency, semi-strong form efficiency, and strong form efficiency. So you should be able to like write something about this this efficiency, right? It's very important. So before we look at an illustration, right, all questions from this material, all questions in this material is adopted from ICANN Pathfinder, and as well as all other relevant tests as well, right? Yes, it's adopted from ICANN Pathfinder, as well as most of these questions are compulsory questions, right? Are compulsory questions in the Pathfinder. So before we look at an illustration to all these, to ensure this discussion, right? So please, if you have question for me, please, you can unmute your mic. If you have question, you can unmute your mic, please, before we continue. Okay, Morga, Mr. Timothy.
Abbas.
Sorry,
Okay, okay.
I treated a question on EBIT, earning before interest and tax, and I charged tax. But when
I can't hear you. Please, can you be audible?
Yeah. I said I solved a question with EBIT, earning before interest and tax. So after that, I charged tax to calculate, then add depreciation back. But when I checked the solution on the part about, they didn't charge tax at all. So I'm confused. Is it that when we are using EBIT, we don't need to charge tax, or what is it? Or maybe I'm the one missing the formula, sir.
Mr. Timothy, one thing about what is it called? Techniques, or let's say the way Pathfinders and some other relevant tests solve questions, sometimes it's kind of confusing, and there are some things you also need to understand, that there is no one approach, right? I think the question is not on EBITDA, is on free cash flow, right? The question is on free cash flow. Yes, because when you mention EBITDA, I already know where you are coming from already. So that is why I said the question is on free cash flow, and the format I gave profit after tax, right? Add back non-cash items. Is that not so? Right, that is another approach. If you are starting your free cash flow, that is why I don't want to use that approach, because I don't want something that's, you know, see somewhere, you know, like if you use that format I give to you, you still arrive at the same thing. You will still arrive at the same answer. But the approach is that you're using EBITDA. EBITDA, what is EBITDA? That is the first question. Earnings before interest, tax, depreciation, and amortization. Before, right? Before that, when you have EBITDA, right, you don't need to add back depreciation or amortization or non-cash items, because they've not even charged interest, depreciation, and amortization. They've not charged it. That's why it is called EBITDA, right? right? Then you have to attach tax. You have to do tax, right? You have to do tax. So it is after the tax before you now consider increase in non-current asset, with its working capital, replacement cost, and all that, right? So you may need to apply, you may need to use that format I gave you so that you know that you will arrive at the same words, at the same answer with them. Do you understand?
Thank you, sir. I appreciate it.
Yeah, thank you. So you can check your Google Drive. I've sent the material.
All right, sir. Thank you, sir.
Yeah, thank you. Abbas,
Thank you, Abi.
thank you.
Please, I want to ask if an individual want to buy a company share, does it mean that before you go to NGS, you have to carry out the company's valuation?
Yes, yes, of course. Yes, Abbas. Because
But,
can you buy?
but how can I?
Because I'm coming.
But how
Because
can I?
okay, go ahead. Go ahead. Go ahead.
Okay, you can. How can an individual achieve such? Because for you to have all the information, required information.
That is why you have an expert in the field. You have the investment analyst guys. You have the investment bankers. You know, the IB guys. You have the fixed income. They can do that for you, right? But as an individual, if you see if you have time, if you have time, you have to do research, right? You have to do research. Now, Fatai, there is fundamental analysis and there is technical analysis. Now, there was a question in one of the diets. I think, is it November 2023 or May 2020? I think May 2023 thereabouts, whereby examiner is asking what is the difference between fundamental, fundamental. I was like, fundamental in ICANN, like, fundamental analysis and technical analysis. Now, you want to buy shares, what is fundamental analysis? It is used to analyze the financial health of a company for a long-term investment, usually for long-term investment, right? So, as an individual now, what are the things you should be looking at first? You need to, the company itself, understand the nature of the business. Who are the competitors? Who are the board of directors? The board. Because you also need to know the boards. Are they people that are competent? You also need to know the competitors. Not that you go and buy the shares at the end of the day, the competitors are winning. All right. Then the market price of the shares is not even increasing at all. It's just there. You have to know this. Equally, you carry out financials analysis. To the best of your knowledge, you can just do small things. You have to understand that, okay, what is the company level of gearing? What is it called? The PE ratio and some other valuation techniques, right? About that you need to know. So when you carry it out and you look at it, that okay, it is worth buying, you can quickly go and buy. It means that you are carrying out the financial health of an entity fundamental, using the fundamental. If you have enough time, you can use free cash flow. That will actually take your time. If you are not an expert in the field, right? Now, the next thing is technical analysis. The question is, what is technical analysis? Technical analysis is used to assess a company historical price to know when to buy the shares. Plus, some investors uses technical analysis. Now, how did they make use of it? They will check the company's historical price and see if the company historical price is increasing on year or on month basis. Then that will give them what will now happen in the next 5 months or in the next. So they will enter into the market when the market price is low, using the what? Technical analysis. They will enter into the market because they are looking at the current price. That means you are using technical because you are looking at the current price. Oh, the current price is 1,000. It is too high. Oh, it's not worth buying. But an expert again can decide to buy because the 1,000 naira may be 2,000 naira. But because you are using a technical analysis as someone that, oh, should I buy? It's 1,000, it's too high. So how many numbers of shares do I want to buy? That means I have to have like 500k, 500 divided by that 1,000 something, just give you one small shares like that. So where investors entering the market based on the historical price, then when the market price is low, they will quickly enter the market. They will buy. But however, the investors need to be very careful as well, because it is better for me to buy a company who is owned overvalued, or let me don't use that word. It is better for me to buy a company shares if the current market price is even higher than others, than to buy a company shares whose market price is lower. Now, the growth rate of the one that has the highest market price will definitely be different from the one that has lowest price. And you can't compare their growth rates. You can't compare them. So what they do is that, they will enter into the market because it is 15 naira. Then they will now be looking at the market. When it is 16 naira, they will quickly sell. So they are using the historical price to determine the entering point. So the examiner may ask you a question that what is the difference between technical analysis, you can check November, technical May 2023, technical analysis, fundamental analysis, and the current stock price. They are two different things. The fundamental analysis talk about analyze the financial health of an organization for long-term investors, while the technical analysis make use of the historical price for a short-term investment, while the current stock price represent the current stock of the market. Another question that the examiner may ask you is what we call intrinsic value. The question is, what is intrinsic value? Is the true value of a company, the value of a company. So as an individual, you have an expert, right? If you don't want to go through stress and all that, you have an expert that those guys, they can do it for you. They'll tell you that, this is an entry point, you can buy or you can sell. So you just need to pay a consultation fee and you move from there. Do you get? Boss.
Thank you.
Yeah, you're welcome. Mr. Taufik, quickly.
Thank you, sir. Hello, sir.
I'm with you.
Yeah, my own is not a question per se. It's just like, I don't know, maybe suggestion or appeal. The last diet question, that number one. I saw something like demerger. So that demerger just, I don't know, spoil everything. I don't know. Maybe you are going to assist us in the mock-up examination, this thing that we normally do at the end of the lecture, or so that we solve it. So that's my own. I just want to appeal.
Taufik, let me tell you something today. That question is not difficult. And there is something that the examiner wants to test. Do you really understand valuation of the business? The question is, what is the merger? That is the first question. And that will take us to reconstruction, reorganization. That will take us to Yes, reorganization and reconstruction. Mostly, the merger occurs when companies are not doing well. So they can split the subsidiaries. They want to stand on their own. So if the subsidiaries want to stand on their own, they are together before. What is the value of the company when they are together? Then, after the split, after the demerger, what is the value of the company? So these are the things you just need to understand in valuation. And guess what? The free cash flow will still play out, or the price earning ratio will still play out. Depends on the whole story. Tawfiq. So it's not even a problem. That question is not a problem, like I said. And maybe it's one of the questions we'll solve in our intensive class, right? I think I have about 2 of them. They're about the mock one and the what is it called? The question. So it's not a problem. So
Thank you, sir.
we'll solve it. We'll solve it. Thank you. Illustration. Okay, we've done this. This question, you can check examiner comments. Illustration 2, May or November 2023. You can check. We have illustration 3. Should we start from illustration 3 or illustration 5? Illustration 3 or illustration 5?
Hmm.
You said?
Illustration 5 looks more complex.
Okay, illustration 5. Okay. Okay, that's fine. Okay. Illustration 5. Please check your material. Illustration 5. Okay. This question is abducted from ICANN Pathfinder, May 2024. Question 1. Okay, please, can someone read? Nobody to read, Abby. Okay.
Okay, can I read?
Please go ahead.
Okay. From the required section of the question, using the information provided, prepare a report for Bolade's board by A, calculating the value of one share in KL based on each of the following methods.
Okay.
Number
Now,
one, figure.
thank you. Calculating the value. Calculating the value of one shares in KL based on each of the following methods. Value of one share, that is market price. May 2024, question 1. Calculate the value of one share in KL based on each of the following methods. Right. Value of one share, that is the market price. Using the net assets, you have to present a report for Bolade using the net assets the revalued, the price earning ratio, the dividend yield, and the present value of future cash flows. Explain the advantages and disadvantages and disadvantages of each of the 5 methods. So you can give them one advantages or two advantages of each of the methods. Then what are the possible benefits from the merger between Bolade? That one, when we get to merger and acquisition, we see the benefit of merger. Right. So this is the question, the requirement, right? And this is what the examiner say we should do. So we should not forget that whichever method we want to use, all we want to calculate is to determine the market price, right? That is why the question says value of 1 share. Is that not so? Value of 1 share means the market the market price. So the question now, Olalekan.
Good morning, sir.
Morning.
So, continuing comment, sir. I don't know how many questions do you plan to solve this morning, sir?
What happened? Anything?
Sir?
Anything? Why did you ask? Anything?
No, I just look at the question number 2. As in that one is more technical than question number 5. So that's what I'm asking. Maybe if you are done with this one, probably you can still help us to solve number 2, sir.
No, it's not technical. It's not technical. And I don't believe in that, Sha. You get, but we'll get there. You are employed by Bolade PLC, a very large printing firm with retail outlets across Nigeria. Its board is considering making an offer to buy 100% of the shares of Kenny and a competitors of Bolade in Aba. Can you see? 100% of the shares. No. 100% of the shares, not 100%, not 100% of the shares and the debt. Don't forget that the question says using the present value of future cash flow. Class, the present value of future cash flow is your free cash flow. It can be equity, or it can be free cash flow to the equity or to the firm. Class, it can be what? The free cash flow to the equity or what? Or firm. Now, the question just say the present, the future cash flow. Bam. Not that using the free cash flow to equity, using the free cash flow to the firm. From this statement now, you will know that what you will use to determine the present value of future cash flow is what is the free cash flow to the equity. Because to buy 100% of the shares, equity of Penny Limited is a competitor. Of course, when you want to carry out the valuation, the financials will be given to you. Right. So we have this information, the income statement, the statement of financial position, right? And okay, additional information. KL management as some of the company assets independently revalued. Class, independently what? Revalued in January 2023. Those values are shown below. Class, can you see? the revalued amount, you can see the reason why the examiner says using the revalued net asset.
Realizable value.
Right? We can have this, yes. Then the average price earning ratio, right? For listed business class, before you want to revalue an asset, there must be a reason why you carry out that evaluation. There must be a reason, right? Because you want to know how much you will realize. It could be that the company is going into liquidation, want to liquidate, right? Now, the average PE ratio for listed business in the printing industry is this. Class, in another case scenario, this average price earning ratio for listed company may be 9, 10, 15. Class, when you are given like 3 price earning ratio, add the 3 together and divide it by the numbers. We give you the average PE ratio. But because the average is given to us in this question. And the average dividend yield. And the what? The average dividend yield is given in a situation whereby you are given dividend yield to be 6.5, 3.5, 10.5. Please add them together and divide it by the numbers. We give you the average dividend yield. You can see the first question. Okay, now let's move on first. The cost of equity of the business in the printing industry, taking account of industry level of gearing, capital gearing, is 14%. Can you see the reason why I said it is free cash flow? You can see that first statement. Class, when you want to solve a question under valuation of a business, the first thing is your requirement and pay attention first. Because sometimes the weighted average cost of capital will be given to you. In this question, they will give you the cost of equity and also the weighted average cost of capital. Then you will now ask yourself, which one of these two? Which of the two? Please take note of what they want to acquire. They want to acquire 100% shares, not the company shares and the debt. So that is the reason why the cost of equity is given to us as what? As 14% in this question. KL Finance Department has estimated that the company's pre-tax net cash inflows after tax for the next 4 years for trading ending 28th February, before taking account of capital allowance, will be, can you see, we're given the pre-tax net cash inflow. The pre-tax net cash inflow will be more useful in the words and the present value of future cash flow. Now, KL existing equipment has tax written down value of 3.6 million at 28th February 2023. We have the tax written down value. So the tax written down value of 2023 will be opening balance of 2024. And don't forget, the net cash flow is for how many years? It's for 4 years. So the equipment attracts 18%. When you take this balance to 2024, then you have to reduce it by 18%. Tax allowances in every year of ownership by the company, except the final year, of course. In the final year, you have to check for balancing adjustment, whether it is balancing allowance or balancing charge. Right. Now, you should assume that KL will not be purchasing or disposing of any machinery in the year 2024 to 2027, and that it would dispose of existing equipment, only equipment class. They will only dispose the equipment on 28 February 2027 at its tax written down value, meaning that at the end of 2027, the tax written down value will be the disposal or the sales proceeds or the scrap value of the equipment. The Bolade board estimates that in 4 years' time, that is 28 February 2027, it could, if necessary, dispose of KL for an amount equal to 4 times. Class, please take note of this. So if has acquired Kenny, then after the acquisition, I've done my projected cash flow for 4 years. Then after the acquisition for 4 years, and I said that, oh, at the end of 2027, oh, I will dispose the company, not asset, oh, the company, I will dispose it. Let me sell it. Let me dispose it 4 times, 4 times, 4 times, 4 times, 4 times after tax cash flow, meaning that at the end of 2027, I will dispose it 4 times, 4 times the after tax cash flow, meaning that at the end of that 4 years, 4 times that after tax cash flow, I will dispose it off in that amount. Ignoring the effect of capital allowance and the disposal value of the equipment for the year 2027. So, oh, let's start, right? They say we should write a report. Okay, oh, let's just do small thing. Then you can modify it, right? You are employed. Okay, oh. So that's a solution. I'll be very happy if we can solve 3 questions. So, like 3 questions. But with this time, I think 2. Okay, so just a solution. We are writing a report, right? So whichever format you want to use, I believe we are all professional colleagues. And we write reports in our offices. So use any format that works for you.
Subject.
Okay. As I said, any format that works for you, please. There is no one thing about SFM is anything that just works for you. The pattern, the formula that works for you, use it. All I know is that you still drive at the same point. Okay. Why is this nation? Okay. So you're writing to the board, and what will be the subjects? Valuation of quality. You can say valuation on business valuation. Business valuation of quality. You can use any subjects that you feel you want to use. So that's fine. Shall I use subjects that covers
It's
the basis of
Bolade, not Colade.
But you are writing a report. You are writing a report to you are being employed. And it's Kenny itself, it's not Colade, it's Kenny Limited. Business valuation of who? Who is the owner of these financials? It's KL, the company you want to acquire. Is that not so? It's the company you want to acquire. That is why I say you are writing the report to the board. calculating the value of one share in color in Kenny Limited. You get? You get?
Yeah.
Okay. So, why is this thing like this? Okay. So, can do a brief introduction. Right? Why is this thing jumping? What happened? Okay. This report, we just do introduction, right? This report represents the valuation of Penny Limited, focusing on historical because we valid price earnings earnings, right? Earnings is like this, right? That's away earnings and dividend, the dividend, right? Dividend yield and present value of future cash flow, or we have to state the years 2024 to 2027. Okay. The question just say we should calculate the value, no recommendation. Okay. Okay, that's fine. Would have stated that it also include the recommendations, right? So we start represents. So we start from the net assets. So you can do your workings inside, or you do it as appendix, just bring in the figure, right? So whichever one that works for you, you can use it. So it net assets, that is historical cost. So you can write a short note on historical cost before. So you can do that now. Before the calculation, right? So this method uses or use historical costs of an asset. So you can just write this a short note on that. Then how do we make use of the historical costs? So let's quickly check what we have. Class, total assets minus our total liabilities, right? We don't need to write market price like this. So market price equals to total assets, right? You can do your workings outside and I don't know what happened to my cost to sell. So just manage. Total asset, right? Yes, total liabilities. So divided by the numbers of shares. Divided by numbers of shares. It's keyboard. Okay, that's fine. Please, we just manage this. What will be the total asset class? Let's check it out quickly. Total assets Okay. Now the total assets we have 3.5. We have 5.3, and this is non-current asset. The non-current asset is the non-current asset is 8.8, right? Why the current asset is 6.3? Is that not so? So okay. So are you there? Kenny? So please, you give me figure.
Yeah, I'm here, sir.
Okay, that's fine. 8.8 plus problem here. Oof.
6.3.
Just a minute. I don't know what to my keyboard. Okay. Yeah, even copy self. Oh, I don't know what happened to my keyboard. The plus sign is not working. All my village people. Taib. Taib, are you
Yes,
there?
sir. Yes, sir.
You see these village people, Abby? Imagine. Plus sign is not working, but let's just manage this, right? So 8.8 plus what is the current asset? Class, please check your notes. What is the current asset?
6.3.
6.3, right? Minus what is our current liability? Yeah, go past them. Sure.
5.8.
5,
5.8.
5.8. Non-current liability, what do you have? This is the non-current liability. Away. What is the non-current liability, class?
6.3.
0.3.
Hey, it's not 6.3. Oh,
14.1. 15.1.
no. Let's do it this way. Now, wait. The current liability is 5.8. Is that not so? Now, the non-current liability, yeah. This is this, right? This is the current liability now. This is the non-current liabilities. Is that not so? Bond.
Yes.
That is
Yeah.
okay. Okay. Thank you. So that is 3.0. 3.0 divided by what is the numbers of shares? I can get numbers of shares. Okay. What is the numbers of shares, class?
2.1.
2.1. Okay. 2.1 divided by 1 never, right?
Yes, sir.
Yes.
Okay. 2.1 divided by 1 never. You have good. Okay. We'll have 2.1 million shares. Right. So if you divide it, you have 2.1 million.
Sorry, please. So why are we adding no current assets, no current liability? I mean, The 3.0. Why did we add it? I thought it's supposed to be minus.
This is total assets, total liabilities. Can you see? Total liabilities is what? 5.8 and 3.0. Is that not so?
Yes.
This is minus here.
But you put plus 30.
This is total assets. This is total liabilities. This is minus here. Total assets minus total liabilities, we have net assets. Is that not so?
Yes, yes.
Divided by the numbers of shares, we give us the market price. So what is the market price?
Okay, it's fine.
3 naira.
Oh, I don't know what happened to my keyboard, but okay, just manage. Market price is 3 naira. What? Just 3 naira.
3 naira per share.
Okay, 3 naira per share will be the market price. So what is the next approach? We are done with this, right? This is the value. This is the value of one shares according to the question. Is the value of what? Is the value of one shares. So let's quickly move. The next approach is Mutil.
Hello, sir. Yeah, before we move, sir, I think we are using historical cost. Shouldn't our non-current assets be at original cost instead of the book value cost?
Michael.
Sir.
Michael. Total assets.
Yes.
Total assets.
I'm confused about our non-current assets because we are using the book value.
Wait.
Because the original cost of the asset was stated in the financial statements.
Wait now. I understand your point. Non-current assets.
Yes, our non-current assets.
Okay. The question is, what is book value? And what is historical price? Let's go back. Interesting. So let's check back. Okay, class. This is this. Do you know that they've considered depreciation here? And that is the reason why you see 3.5 and you see 5.3. Michael. So the 3.5 and the 5.3 is the book value. It's not the carrying amount. It's the carrying amount. And that is what we base our valuation on. Your depreciation. Of course, you have an asset. You have to depreciate it. The value. After depreciation, what do you have? It's the book value. It's the carrying amount. So when you are doing a valuation of a business, not because I say, oh, it is historical cost. It is historical cost because the real cost minus the depreciation, we give you the book value or the carrying amount. Is that also? We give you the what? The book value or the carrying amount. So the book value there is also based on historical cost. Michael, are you there?
Yes, sir. Yes, sir. I'm here, sir.
Okay. So, the next approach is the revalued net assets revalued, right? Which is the realizable. The same approach, we have the total assets and the liability. But in this case, we have some revalued assets. Since we have some revalued assets, What are the revalued assets? They revalued the land and building. They revalued machine, which is non-current asset, right? Now, let's pick it. The non-current assets. The non-current asset, right? Non-current assets. So you give me the value for the non-current, for the revaluation for the non-current assets. So what is the revalue? Freehold building. What is the revalued amount?
8.3.
It's 8.3. Machine, what do you have in machine?
4.1.
Okay, 4.1. 4.1. When you add this together, what do you have? 12.4, right?
Yes.
So thereafter, we have the current asset, right? This original cost of this asset is a very big trap. Most of students will just go and use the original cost of the assets because it is historical cost. Class, you're even in line with what is it called? IS1. It can be on historical cost or revalued. Then when it is historical cost, if you check the financial statements, when it is historical cost, it does not mean that it does that cost of the asset that will be there. You have to consider inflation, or you have to consider depreciation, where you have the book value. Is that not so? So we have inventory is depreciated, is revalued, right? Is that not so?
3.1.
Okay, that's fine. Inventory 3.1. Now, the question now is, you will see that we have to add all other current assets. We have to. That is one of the disadvantage of using realizable, because after the revalued amount, you have to add all other assets to it. You can't just say because you just revalue. Yes, these are just the assets you revalue. Any other asset will be added back to the assets. So we cannot just ignore.
Will it be added back on the historical cost?
Will be added now.
Okay.
Right? You can see we have to add. This is revalued. Receivable is not revalued. The receivable is not revalued. You have to add it. The cash and bank remain the same. I think we have intangible assets here, and they only revalued freehold and machine. We have to add the intangible asset because it is not revalued. That is one of the disadvantage, is that even non-revalued assets will be added in the calculation of the of the net asset revalued. Imagine the asset you've not revalued, you add it back to the one you revalued. That is confusion, right? It's somehow confusing, right? So what do we have here? If you had these two, what do we have? If you had these three, sorry, what do you have? Quickly, please.
6.4.
6.4. Okay. So if you have this will give us, if you had these together, we have our total assets.
18.8.
Thank you. Let's say 15.8, right? So we have our non-current total liabilities. I'll just pick it.
18.8. 18.8.
18.8.
Okay, 18.8. Thank you. So I'll just pick it. Total liabilities, right? So I will just use what we have. What is this now? So I'll just use what we have. We've calculated, we've got 5.8. 5.8 plus 3.0. Wow. Okay, plus 3.0, right? So we have to subtract it. If you add these two together, what do you have?
8.8.
8.8.
8.
So what is our net assets?
10.
Okay. Our net asset is 10. Net assets. Net assets is 10. Right. So what will be the numbers of shares? 2.1 is the numbers of shares. Right. Numbers of shares. $2.1 million. Okay, class. What is the market price?
4.8.
4.46.
Price. For never.
0.8.
0.8 per share. So this will be the market price, class. That is the value of one share. The examiner said the value of one share. This will be the value of one share, class. Wow. This thing is not. Okay. Next. The price earning ratio. The price earning ratio. Class, what is the formula for calculating the market price using the price earning ratio?
Price earning ratio times N.
Okay. Yes, you need to know that formula. Once you know the formula of price earning ratio, just do subject or just collect the light. What is it called? Cross multiply. Right. Market price equals to sign is not working, but that's fine. The price earnings times earnings per share, or earnings per share times price earnings. So we need to determine earnings per share. We check the formula given to you. Profit after tax. Thank God. Profit after tax, right? Minus preference dividend. Is preference dividend given to us in this question? Profit after tax. Let's check. Profit after tax. Minus preference dividend. Class, is preference dividend given to us in this question? Am I the only one in this class? We
No, sir.
There's no preference dividend.
There's no
No,
preference.
no, no, we are not.
oh, okay. That's fine. Profit after tax is 4.4 minus divided by the numbers of shares. Okay. 4.4 divided by the numbers of shares, 2.1 million shares. So what do we have?
2.1.
Okay. Please, we should indicate 2.1 can be 2.1 million. We it is way. 2 point what? 2 point what?
2.1.
2.1 naira per share. Right. So market price is equals to the price earning ratio given to us in this question. What is the price earning ratio? The average PE
9.
ratio. Class, don't forget this thing, oh, please. This average examiner may want to test your knowledge by adding what is it called? I'll send one FM question, right? I think I forgot to add it to this question actually. Right. So what the examiner did is, we calculate, we get our profit after tax because it is given to us. Right. In that question, the examiner gives what is it called? The profit of the previous year. Right. I'll share the question after the class. I'll share the question. Then I will refer you to the YouTube so that you watch the suggested solution. Right. Now, should in case the examiner wants to test your knowledge on that, so you can attempt it. So this is average. Please, when you are given like 3 average, when you are given like 4 average PE ratio, what is it called? PE ratio to be maybe 5 or 4 or 3. Please add it together, divide it by the numbers so that you get average, please. So yeah, what do we have? Price earning is 9 times 2.1 naira per share. So what do we have? What do we have? You multiply what do you have?
18.86.
Okay, 18.86. 18.86 naira per share. So this will be the market price.
Hello, sir. Can I ask a question, sir? Sorry to draw you back.
Okay, go ahead, please.
Yes, I was told that when a company is not listed and we are giving a listed PER, that we need to, what's language? We need to bring
Bootstrap
it down. That's because we are not listed and the PER we're giving to is being listed, so we cannot use the same amount.
No. You're actually correct that if it is not listed, but is this company listed company or unlisted? Is it PLC? It's PLC now. So the question is even silent whether it is listed or non listed. But if you have a shares, in as much as it is public, right? Is it mentioned? The examiner mentioned that it is unlisted company. I think it wasn't mentioned. But you are correct. The price, not to bring it down, the price earning ratio usually of unlisted company usually lower than a listed company, because I actually mentioned in that it's difficult to determine the market price of unlisted company because you can't get their PE ratio. You can't get their PE ratio is usually lower, right? No, it wasn't stated that it is listed or not listed though. But in as much that you are acquiring a shares, class, in as much that you are acquiring a shares, 100% shares, that means it's a listed company now. At the beginning of this class, at the beginning of the question, at the beginning of the question, it was stated that they acquire 100% what shares. It's a listed company. Shares, for you to have shares now, that is a listed company. So they will have price any ratio. Mr. Timitoko, you're actually correct when it's not that to bring it down or to reduce it, right? The logic is the what is it called? Is that when you have a price earning ratio of unlisted company, usually lower than a listed company. Do you get Mr. Timitoko? Mr.
Yes, I'm with you, sir.
Okay. That's
Thank
fine.
you,
Are
sir.
we good now? Yeah. Okay. So we can move right. Next. This is just an introduction, right? This is just an introduction to this thing. So we have dividend yield. Dividend yield. Dividend away. Dividend yield. We have dividend yield. So okay, it's not in capital letter. So we have dividend yield, right? So how do we determine the dividend yield? What is the formula, class? To calculate market price.
Dividend per share divided by dividend yield.
Equals to dividend per share divided by dividend yield. And dividend yield is given to us in this question as average. So how do we determine dividend per share? Dividend per share. How do we determine dividend per share, class? We're given dividend in this question. Is that not so? Dividend is given to us in this question. What is our dividend declared?
1.1 million.
1.1 million. Thank you. Right. That is the dividend. 1.1. So divided by the numbers of shares. 2.1 million shares. Right. We give us dividend per share. What do we have? When you divide it, what is the dividend per share?
0.5 naira.
0.5 naira per share. Class. Dividend per share equals to dividend value divided by numbers of shares. Going forward, I will not be writing this formula. It's because this is the first class on this, so I just have to bring the formula out so that you get it. So this will be the dividend per share, right? So therefore, market price equals to dividend per share is 0.5 naira per share times what is the dividend yield given to us in this question?
6.
6%.
No, the examiner did not say, okay, 6%. Okay. Now, just be very careful here. Class, just be very, very careful. If the examiner says 6, use the 6 given to you. If the examiner says 6%, use 6%. Just like this PE ratio. We know that this is supposed to be in percentage, but the examiner said 9. Just use the 9 given to you in the question. Like that. Don't try to say, because it is PE ratio. Oh, PE ratio is, you need to convert it. Then he's now say 9 divided by 100. Okay. The examiner said 9. Use the 9. Right. So 6%. Oh, divided by 6%. What do we have? What is the market price?
8.3.
Okay, 8.3. 8.3. 8.3. Per share. Someone say, can liability be revalid? Your inventory can liability be revalid? You can only Esther. Oh, my network
Yes,
went off.
sir.
I think you asked a question, right?
Yes,
That
I'm
can
here.
liability be... So you can determine the market value of your liability now. It can be revalued, of course. If you want to revalue your current liability, maybe your loan. I'm talking about loan now. Maybe preference shares or bond. You can determine the value, market value. Right?
Okay.
That is the market. That is the value. So you can determine. So examiner may want to add that. I think that, I saw a similar question like that in FM class, right? Where the examiner would say that, during the course of the acquisition, they have to consider the market value, what is it called, of preference shares and bond, right? So, do you get?
Yes, thank you, sir.
Welcome. So, lastly, is on present value of future cash flow, right? So, E, determination, can number it, please, of present value of future cash flow. Class, you can see the way I'm presenting my work, right? So please, presentation is very important too. Very, very important. Okay. For how many years? The present future cash flow will be for how many years, class?
4 years.
For 4 years, because we're given the net cash flows, right? We're given the net cash flow. Okay, it's for 4 years. It's for 4 years. For 4 years, 2024. Nice. 2025, 2026, and 2027. Okay. Please make sure you present your work very well, please. Okay. Very important, please. So, net cash flow, is it after tax or before tax? Net cash.
Before tax.
Pre-tax net cash
After
flow.
tax, cash flow.
Okay. Okay. Is pre-tax cash flow pre-tax before taking, okay, pre-tax, okay. Net cash flow 4.6, 4.3, 5.2, 5.7. Right. So we do our tax. How many percent is the tax?
21%.
21%. Is that correct? Please confirm. Is it 21%? Okay, 21%. Okay.
Yes, sir.
21%. 21%. So quickly, what do we have here?
0.966.
0.96697. Next, what do you have? Please, can we be fast, please?
0.97.
0.90.
90.
So what do we have again?
0.90.
0.90.
1.1.
What do we have here in 2026?
Is 1.1.
1.1.
1.1. So what do we have here?
1.2.
1.2.
Yes. No. No.
Oh, can you mute your mic? Yes. Thank you. So after this we have net cash flow. Net cash flow after tax. So when you less it, what do you have here?
3.6.
3.6. What do you have here?
3.4.
3.4. So what do we have here?
4.1.
4.1. What do we have?
4.5.
4.5.
4.5. Okay. Now, you know there is capital allowance. We're told that there is capital allowance. Yeah. Is that also? In this question, we're told that the equipment, there will be a capital allowance for equipment. Right. Let me show you. And we also have a disposal as well, class. So these are the things you need to take into what consideration in your cash flow, because after you've considered your net cash flow, don't forget it makes use of cash flow. It is free cash flow to equity. It is equity because you are going to use the cost of equity to discount. Now, we're told that the equipment will attract 18% on a reducing balance, and we have to dispose it at the end at its tax savings, at its tax written down value, right? At its what? The tax written down value. So, class, we have workings. So let's say we have tax saved. We'll also have disposal. Okay. So workings, right? Yeah. What do we have here? Items, right? After items, what do we have? CA, right? Tax.
That's saved.
Tax saved. 21%. Tax due. sometimes they will tell us that tax is being paid. They just question is just silent about the tax. So we assume that the tax is being paid in the year at which the cash flow is being generated, right? So we can say, okay, we're given the tax sitting down value for the year 2023, which will be opening in 2024. And we'll have to reduce it by 18 what? By 18%, 3.6 million. So 3.6, that will be the balance brought forward for the year 2024. 2024, we'll have TWV. Okay, I have to shoot this. This tax sitting down value. Okay, 3.6, right? 3.6. 3.6. Then CA is 18%. So what is 18% of this?
$0.648.
Okay. 0.648. So what do we have? This will be 0.648. So what will be the tax saved? 21% of 0.648. What do we have?
0.136.
0.136. So this will be 1. All right. We have 2025. So the difference, because it's on reducing balance. What do we have here? What is the difference?
2.952.
2.952 will be the tax sitting down value. Tax sitting down value brought forward. 2.952. We have capital allowance, 18%. So what is 18% of this?
0.531.
0.531. 0.531. So this will be 0.531. So tax saved
0.111.
0.111.
Mm.
Okay. So this will be 2. 2026. So what would be the difference? What is the difference?
2.421.
2.421. 2.421. Okay.
18%.
Okay, I'm coming. Tax sitting down value. Right. CA. 18%. So what do we have here?
0.436.
0.436. 0.436. So what is 21%?
0.092.
0.09. So this is 3. Okay. 2027. So what do we have here? What is the balance?
1.985.
1.985. Tax sitting down value. 1.985. You can see that this is the final year, right?
Yes.
But we're told, don't forget, class, don't be carried. Don't forget that at the final year of that asset, you don't need to charge capital allowance. So you need to adjust. You need to check for balancing adjustment. We did something like this under capital investment. You need to test for what? You need to test. Please, can you mute your mic? Okay, we need to test for the adjustment, right? But in this question, we're told that the tax sitting down value will be the sales proceed class. You should assume that KL will not be purchasing or disposing machinery with this, and that it will dispose of the existing equipment. It will not dispose of equipment on 28th February 2027 at a tax sitting down value. At its what? Tax sitting down value class. So meaning that the tax sitting down value will be sales proceed of this asset, right? Will be the what? Sales proceed or the scrap value of the asset will be 1 point what? 1.985. What is the difference? The difference is 0. Is that not so? That is what we have here. At the end, there is no capital allowance because we have 0, right? The tax sitting down value is equal to the what? Is equal to the sales what? To the sales proceed class. So therefore, our sales proceed, I know that some student will now come and we come here and say sales proceed. Class. Sales proceed. They now charge tax on the two, your net cash inflow and your sales proceed class. Under the Capital Gains Act, when you dispose an asset, you don't need to include it in your cash flow. It's capital gains. It's capital gains. So why will you tax it? It's capital gains. And that is the reason why in computation like this, sales proceed or disposal will come after what? After tax. So disposal of equipment. So what is the tax? What is the disposal? 1 point what? 1.985. So what will be our tax saved? 0.136. 0.111. Next, 0.092. What is the last balance? Okay, so we don't have anything there. So then what do I have before we discount? What do we have here?
$3.736.
3.736. What do we have here?
3.511.
3.511. What do we have here?
4.192.
4.192. What do we have here?
6.485.
6.485. So DCF, which is the cost of equity. What is the cost of equity given to us in this question? How many percent? I think 14%, right? Is it 40%? 14%, right?
Yes, it's 14.
14%.
Yes, sir.
14%. So what do we have? Year 1. 2024 will be year 1, year 2, year 3, and year 4. What do we have here?
0.877.
11 or
0.877.
0.877. What do we have here?
0.769.
0.769. What do we have here?
0.675.
0.675. What do we have here?
0.519.
0.519.
0.592.
Is 0.592.
592. Okay. So what will be the present value? Value.
3.276.
Okay. 3.276. What do we have here?
2.699.
2.6
2.7.
is 2.700 approximately.
2.7.
00.
So what do we
Last
have here?
one. Last one.
Okay.
2027.
Okay.
3.839.
3.839. Ma, welcome back.
2026, 2.829.
2.823.
30.
So
2.830.
okay. So present value
12.645.
Okay, thank you. The present value from 2024 to 2027. Ma, the figure.
12.645.
Okay, 12.645.
I think somebody
12.6.
got 12.66 anyway.
Okay. Now, we should not forget, this would have been the value of the company. The market value, the intrinsic value. Kende, are you there? This would have been the intrinsic value of the company. And what is intrinsic value? The examiner may ask you that determine the intrinsic value. Don't be confused with the word intrinsic. It is the value of the company. It's the true value. This would have been the intrinsic value of the company. If you divide it by share, we have the market price, the value per share of the company. But we will not stop here because we have an additional information that says that Bolade board estimated that in 4 years' time, that is 28 February 2027, when it is 2027, it could, if necessary, dispose of color KL. They can dispose it. When they acquire it, they dispose it for an amount equals to 4 times after-tax cash flow, ignoring the effect of capital allowance and disposal value of the equipment class. 4 times disposal of KL. We can dispose it. Value of disposal of KL. An amount 4 times after tax net cash flow in 2027. And what is after tax? What is the after tax cash flow? This is it. Is that not so? Is this not the after tax? After tax net cash flow after tax 4 times 4.5 times what will be the present value? You know, you are in 2024. You are not talking about 2026, 2027. Then what will be the present value? What will be the present value class? Then you need to multiply by the DCF of 2024, of 2027, sorry, which is what? 0.592. This will give us the present value. So what do we have?
10.656.
10.656 class. So what is the total market value of the company? Total market value. So
23.301.
Now, meaning that at the end of 2027, they will have this cash flow. At the same time, if they want to dispose KL in 2027, they will still have this cash flow. So what will be the total market value of the company? Will be 23.901, right? Will be 23.901. Because before they can acquire the company, they have to carry out a valuation. What are they expecting? We cannot just acquire company A without any expectation. And this will take us to merger and acquisition, where we have what we call the revenue synergy, cost synergy, and the competitive advantage in merger and acquisition. When you want to merge, if I want to merge with other study center, if next gen want to merge with other study center, we have to consider some benefit of merger, right? Some benefit of merger. If there's no benefit of merger, so there's no point of merger, right? You could see the war play out between the Titan Bank and the the Union Bank. You could also see war play out between the Unity Bank and the Providence Bank in Nigeria, right? So there is no point of merger because everybody wants to meet up with the CBN recapitalization. Oh, we want to avoid corporate failure. Corporate failure is another interesting topic because we want to avoid corporate failure. Like the CBN recapitalization policy, everybody wants to merge, and you see companies doing rights issues every month now. Everybody wants to meet up with what is it called? The recapitalization policy. Then if you don't want to meet up, you have to merge. Right, and that will take us to corporate failure. And we could see an example of corporate failure. We could see what is it called? Heritage Bank. What happened? They fold up, right? They fold up. Now, this is the total market value of the company, and you can divide it by the numbers of shares, right? We give the market price of a company. Class, above all, the future cash flow or the free cash flow usually provide the highest what is it called? Highest cash flow or highest market price. Class. If you divide this now, let's say market price. My cost to sign is not working here. Oh. So let's say 23.301 divided by this 2.1 not naira, 2.1 million. What do we have?
11.1.
11.1.
11.09.
Okay. 11.0.
11.09
per share. Now, can you see that among all, it gives the highest what? MPV, the highest market price. That is, if the examiner asks you to advise, in that case, they will not say you should advise Bolade because Bolade said Bolade is the one that wants to acquire KN. Right? In that case, they say you should choose what they will tell you that you should choose what KL, Kenny Limited, can accept. Can accept. That is when you want to advise, when the examiner wants you to advise the company. Right? But in this case now, Bolade wants you to, as an employer, you are the employer, right? want you to do the valuation. Do the valuation, give us the value. Is that not so? So it is now left for them to now choose which of them. But even if they choose the lowest one and they submit the bid to Kenny Limited, they will not accept it. If they don't want to accept it, they won't accept it. Yes, they won't accept it. They will tell you that, okay, the price is too small. What they can accept is the present value of future cash flow, so you pay more. Right. So I think very simple, right? It's a very simple question. Okay, please quickly unmute your mic so that we can move to the next question, please. Please.
Good afternoon, sir.
Good afternoon.
My question is on that on the tax savings. If I can remember vividly, when we are computing the tax allowances, I know we are told that in the year of disposal, there won't be any tax allowance to be computed, but tax savings will be computed based on the amount gotten for the tax withholding value, tax written down value. But in this question, we didn't charge that 21% of that 2027 on it.
Yes, because the question says that the examiner says that the sales proceed will be equals to the tax written down value. The difference is 0.
Okay. So that was the reason why we didn't charge tax on it.
Thank you.
Thank you.
Yes.
Thank you.
Yeah. Any other question? Okay. So I think we need to move right. So I have another question here. I have another question. Please don't forget to watch the video on portfolio theory. Portfolio theory is an interesting topic, right? Please don't forget to watch a video on portfolio theory, please. That video is not, I think the 3 videos are not up to an hour. Then the material is also in the drive as well. Please. If been long they tested portfolio theory. And most time, if they want to if question want to come, usually on the alpha value, the calculation of alpha value, whether alpha value, whether it is overpriced or undervalued or underpriced, or you hold, right? You hold the stock. Please, the 3 videos are on the playlist. It is less than the 3 videos are less than an hour. The mass should be of 1 hour mass. So please watch the video. There's solve questions on portfolio theory. Please. So in our intensive class, we just pick a question on portfolio theory.
Hello, Miss Ivy.
Yeah, Muti.
Yeah, sorry. I thought there's no longer portfolio in the
God, that is now what I see. But when you check the God, if you check this, the what is it called? The study pack, I was surprised. that I saw portfolio theory there. I was surprised because my plan before, I actually have it. My plan before is that portfolio theory has been moved to FM, right? It has been moved to FM. But if you check pilot self, you will see portfolio theory. If you check the new study pack, you will see portfolio theory. I'm even confused that in the syllabus sent earlier, no portfolio theory. Now there is portfolio theory. If you look at that, if you look at the syllabus sent as well, there is no forecast, cash flow forecast. But if you check the what is it called? But if you check the what is it called? The part, you still see a forecast. I was like, so if you check FM, you see forecast, you see portfolio theory. Then the question is, where did they want to test it? Is it in SFM or in FM? So it seems it's just somehow, right? Do you get?
Yes, sir.
So please, it's very important.
Okay. Thank you, sir.
Yeah. So please, you can take water. Please take water for 2 minutes. Taib. Who will buy us energy drink now? At least so that we'll have strength.
I will.
Now 40 participants.
Mr. Taufik. Mr. Taufik.
Absent.
What can I do for you?
Okay. Oga Taufik. Who is against us?
We are together. Progress.
So
Mr. Taufik. Mr. Taufik is against us.
So who will buy us energy drink? Because
I said I will.
Okay. That's fine.
I'm selling it over.
Okay, no problem. Kenny.
Let me still reserve my comment. Let me pass SFM.
You pass it. Honestly, you pass it. And this is what I told last diet students is that when the desirable is not available, the available becomes the desirable. Meaning that when you're faced with a question, right, and probably they say you should write something, you see all those things I'm saying in this class, right? That some of you may be thinking that maybe you are going too far, right? Because of I like to add, okay, this is how it works in practice and all that, even if I'm not there now, right? So if you look at it and you have a question like that, then you remember that, IB has mentioned this. And look at who knows that I can test technical analysis, intrinsic value, and fundamental analysis. Nobody knows that I can test it. We just saw it in May 2023. Valuation all true. Valuation all true. About 4 questions on valuation of a business. Right. So most of all these things we discuss in class, you may just see it and you say, okay, it's like this. You're right. So when the desirable is not happening, the available becomes the desirable. So we don't drink water finish. So can we start? So this question is also adopted from ICANN Pathfinder, Zinco. Question, please. Can we check? This is illustration 3. Illustration 3. Oh, this is another 15 marks question. I think this is November 2023. This question 2 is also May 2023. Yeah, May 2023. Question 1. Okay, please, can someone read? Required.
Required. Prepare a report. No, Shelley. Not me.
Can you see
Prepare
it?
a report. that gives an estimate of Zinco using 1, asset valuation, asset-based valuation, 2, PE ratio, 3, dividend-based valuation, 4, the present value of expected future cash flow. Then 5, discuss the potential accuracy of each of the methods used and recommend with reasons a value of range of values that PT might bid for Zinco. State clearly any assumption you make.
Okay, thank you. Can you see that for every question on valuation, on methods, now in this question, the question says that discuss the potential accuracy of each of the methods, meaning that when you calculate it, you have to talk about it. That you should not forget that asset-based valuation make use of historical is not realistic, right? The PE ratio is also subjective because it's make use of accounting profit. Then you talk about the dividend-based valuation. It can only be applicable to dividend-paying companies, and on the basis of our assumption that the dividend will grow, right, in the future, while the present value of estimated future cash flows is, it also has its own disadvantage because you don't know the numbers of years that the company will start generating out. The company will start generating cash flow. You are just projecting, right? Making a projection. You don't know, maybe it is after that 6 years or it is from that 3rd year to 5th year. So you don't know, but you just want to like forecast what will be the future cash flow. So we need to recommend. Yeah, in our recommendation, yeah, we look at it. Who is acquiring who? All right. They say prepare a report that gives an estimate of Zinco, and or a range of value that PT might bid for Zinco, right? So meaning that the maximum amount, the maximum price that Zinco will be willing, PT will be willing to pay Zinco should be the highest of all. The highest of all. Why the minimum should be the lowest one. So when you are advising, when you want to advise, I'll have to pick the highest one. Okay. Of course, the present value of your cash flow will always be higher than other method, because you're talking about the expected future cash flow here. So we're given information about illustration 3. Okay.
So, can I go on to read?
Yes, please.
Yes. Balemo Temidayo PT is a large engineering company listed on the stock market. The company is considering the purchase of Zinco, an unlisted company that produces a number of engineering components.
Okay. Now, can you see that an unlisted company, it is usually complicated to determine using the price earning ratio? But however, when the examiner use price earning ratio, well, the note is that the price earning ratio of unlisted company is usually lower than a listed company, because it is not quoted in the market, right? So you can go ahead, please.
Can I go on?
Yes, please.
Okay. The board of directors is concerned about the appropriate price to pay for Zinco. As a starting point, it has been decided to provide a range of valuations based on different industry recognized techniques.
Okay.
Summarize. Okay.
Okay. Now, you're looking at the appropriate price to pay for Zinco is acquisition, right? So they need to provide a value of a range of valuation. So we're given the statement of profit or loss. operating profit before exceptional items. Then we have exceptional items. The question is, what are exceptional items? Interest paid net, dividend, the statement of financial position is given. Of course, when you want to carry out evaluation, unnecessary documents or information should be provided for the what? For the valuation of the business. So the statement of financial position, then additional information. Okay, additional information 1.
Okay. Additional information 1. If the acquisition succeeds, there will be revenue synergy leading to increase in annual sales revenue of Zincos of 25% for the 3 years and of 10% per year thereafter.
Thank you, class. This is an acquisition. One of the benefits of acquisition, or yes, is synergy. Meaning that if I acquire Temitope PLC, my revenue will increase, and that is revenue synergy. And that is the reason why we see the increase. We see an increase in the sales revenue of Zinco of 25% for 3 years. If I acquire Zinco or acquisition, it will lead to what? A revenue synergy. My revenue will increase 25% for 3 years and 10% year after. That is infinity. Class, that is infinity. If it is for 3 years, the statement of financial position given to us is for how many years? Is for which year? Is for which year? Oh, 2020. The current year is 2020, right? Right, class? So we'll have 2021, 2022, and 2023. Of course, if you are doing a forecast, you use the current year financial information to forecast for the future. If you are doing an incremental budget, you use the current information, the current financials to predict what? To predict the future based on the macroeconomy indicators. We just look at it because revenue don't increase within 2 years. Okay, it should increase now. The question is, what are the strategy to be put in place before you say, oh, it will increase by 30%? What are the strategy? Did you just say, oh, it will increase by 20%? On what basis? Right? So 25% for 3 years and 10-year thereafter, that is infinity. So non-cash expenses include depreciation. We have 4 million for 24.1 million 2020. Income tax is given. Capital expenditure was 5 million in 2020 and is expected to grow approximately the same rate as revenue. Meaning that our CAPEX, that is under financial model, CAPEX, that is capital expenditure, non-current assets. Our non-current assets will increase in line, will grow in line with revenue. And revenue will increase by 25% for 3 years. So working capital interest, payment, and non-cash expenses are expected to increase at the same rate as revenue. We have to jack it up. Our working capital, the interest payment, and the what? And the non-cash expenses. And what is the non-cash expenses? Include depreciation. Now, Zinco has a patent with the current market value of 50 million. This has not been included in the non-current asset, meaning that the non-current asset provided, given to us in this question, exclude the intangible assets, which is 50 million. Plus, operating profit is expected to be approximately 8% of revenue. So the operating profits will be 8% of revenue in 2021. We should not forget that the forecast is for 3 years. The current year is 2020. Then thereafter we have 2021, 2022, and 2023. Class. The operating profit is expected to be what? Approximately 8% of revenue in 2021. Meaning that the operating profit will be 8% of the revenue. And remain at the same percentage in the future years. Remain at the same percentage. Remain the same. Dividends are expected to grow at the same rate as revenue. Everything is at the same rate as revenue. The examiner wants to test your knowledge of how you will apply the growth rate, and thereafter. Thereafter is infinity. Please, you should not forget how we determine infinity under the first question that we solved, free cash flow, right? The realizable value of inventory is expected to be 750 of its book value. So you should know that under the asset-based method, there is realizable here. There is realizable what? Method. The estimated cost of equity is 12%. You can see that you are given cost of equity. The question now say after the asset base, PE ratio, dividend, the question say present value of future cash flow. And you are given what? The estimated cost of equity alone. 12%. This is to tell you that you have to do a free cash flow to equity. Sometimes the examiner will not tell you that do free cash flow to equity. The question says after the dividend PE ratio, blah blah blah, then the present value of what? Of future cash flow. Next is the average PE ratio of a listed company. They've given us the average PE ratio, 30:1. The average earning growth in the industry is 6%. You do the reports. Let me just I'll just calculate the asset base, the PE ratio. Oh, the asset base is even 8 marks. PE 6 marks, dividend 6, present value 5. Okay. Question 1 is adopted from Icon Pathfinder. Can check. So, where do we start from? So this is a solution. So you can do the reports. Mr. Temitope, can you mute your mic? Okay. Thank you. So we start with the based. Put it in reporting format, right? So that will be your please. You can put it in reports, just like the way we did the other one. So just put it in that format. So the asset base. So class, based on this question, which of the method are we using under the asset base Is it revaluation? Is it historical? Is it replacement? Class, which method?
Realizable.
Okay. We are using the realizable, right? So realizable. Okay. Okay. So realizable. Now,
And historical. Okay.
yes, we have to add the two together. We have to add the two together. But the question is pointing towards the realizable. Of course, we cannot just pick this figure and just leave it like that. No, we have to add the historical cost, and that is one of the disadvantage, right? So that's it. So asset base. So okay, our assets. So which year are we using? Is it 2019 or 2020? Is it 2019 or 2020?
2020.
Thank you, 2020, because we use the 2020, the current year. Okay, that makes sense. Now, because the examiner, they proposed you can see the examiner had 2019 and 2020. So then we'll go and pick 2019. So we start valuation from 2019. Okay. So okay. So the first one is this, right? Suggested solution. And don't forget that we have a patent that we're supposed to just use that figure there. But because we have a patent, as a patent with current value of 50 million, this has not been what included. So we have to include it in the what? In the non-current assets. So that is the only asset, right? That we need to include patent. Okay. Patent. So the patent is 50. I need to check the presentation here. Is it a million? Okay, it's in thousand. This should be 50,000, right? This should be 50,000 because the figure is a million. It's in thousand. Okay. Okay. So then what do we have again? The realizable value. The inventory is 70% of its book value. Can you see that? The inventory given to us, what is it called? Michael, are you seeing this class? No. Can see that the inventory is the book value. Okay. Thank you. Can see that the inventory is the book value. That is why this question says, examiner says 70% of its book value. Right, class. Whenever you are faced with question on valuation, please don't be distracted with the noise, with the story. All you need to do is that, what are the things you need to, what are the ingredients you need? That is the only thing that you should be looking for from the question. Oh, you've understand the requirement. Is that not so? You've understand the requirement. The next thing is, oh, what are the ingredients? What are the ingredients you need to pick out? Then you pick the ingredients one after the other. Right? So we have to revalue this 70% of its book value. The book value is 17. What do we have?
11, so 11,
11,900. So we have all other excuse me, we have to add all other assets to it, all other non-current, all other current assets, right? Because we can't just leave it like that. We have to add the non-current assets, the current assets, sorry. So class, so what will be the total? Coming receivables 13,790.
not that.
240. So okay, so what is the total asset?
103,930.
300 and
103.
103,000
930.
930. Okay, thank you. Right. What is the next thing we need to check from the question? The liabilities. So what is the current liability? Do we have current liability? Do we have non-current liability in this question? Do we have non-current liability? What is our liability in this question, please? 600. That is the only liability. There is no non-current liability is not given to us. So we can have here current what? 27,600. Net asset. So what is the difference?
76,830.
Numbers of shares. Okay. 76, 630.
330.
Okay.
330.
330. Thank you. So what will be the numbers of shares? Are we given the numbers of shares? How do we determine the numbers of shares? How do we determine the numbers of shares, class?
20,000 divided by 0.5 kobo.
Okay, thank you. So 20,000. I believe we all know how to determine numbers of shares. So we should not forget our what is it called? Cost of capital, the numbers of share, and other. What do we have?
40,000.
40,000 shares. Right. So what will be the market price if you divide it? Market
1.01.
price is 1 point what? 1 point what?
91.
91 naira per share. Right. This is the what? This is the market price. A range of values. A range of values. Okay. So what we need to do, let's multiply. Let's just get market value, a range of value, multiply it by the numbers of shares. We still write out that same thing times the numbers of shares. We still give us 76. We still have 76. Right, we still have 76. 26,330. Yeah.
26,400.
So what's have the same thing now? What is the difference between this and this? Is it not 76,330? Unless if this figure is wrong.
76,400. The approximation, we approximated
It's
it.
76,400.
Approximation error.
It's approximation.
So what do you have? Okay, let's just leave it. Just calculate it. What do you have here? What is it supposed to be? Anyhow. So what is the next approach? The next one is PE ratio. PE ratio. All right, PE ratio. So how do we determine the market price? Market price. For me, what is the formula? Market price equals to what?
PE ratio times earnings per share.
PE ratio times earnings per share plus when the question is just whether it is the merger or whether it is merger, anything that you want to do, everything is to just, the purpose is just to determine the market price or the market value of that company, right? And that is the reason why you carry out evaluation, right? So now, class, in this question now, we need to determine the PE ratio is given to us already in this question, right? The examiner gave us the PE ratio. Now we need to determine the earnings per share. Earnings per share. Then the profits after tax minus preference dividend divided by the numbers of shares, class. So we need to go back to the income statements. We need to go back and check what happened in the income statement so that we can pick profit after tax. Now, so what will be the profit after tax? What is the profit after tax, class?
5,965.
5,965.
There is a loss of.
That is a loss. And
That's a
it
loss
is
of
profit after
5,959.
Lost after tax.
Yeah.
So now,
what are we doing?
There is a problem here. Yes. So we have to check. We have to cross-check the income statement. What happened? That they have a loss of 596. That is why at a point you want to carry out evaluation, you need to ask question. Right? Now, we should not forget, counting profit is subjective. I can it is well. So You have sales revenue of 112,400. Then you have operating profits before exceptional item. The question is, what is exceptional items? Class, exceptional items are items that do not occur regularly. It is usually one-off. Example is restructuring. When a company wants to go into restructuring, they will incur a restructuring cost. We'll get there under the reconstruction, right? They will incur it. And it is an exceptional item. However, when you want to value the business and you have an exceptional item, it should be excluded. You have to exclude it because they do not occur time to time. There is a probability that if I acquire this company, I will not even have the exceptional items at all. So there is no point of including it in your words in the computation of the profit after tax. Because if the company is a listed company, the shareholders will not accept this report. They will not accept it. They will ask questions. Exceptional items to be 10 million plus. On what basis? And because the company is not on list, is unlisted company. So who will ask question? Unless these guys, business angels, those who venture capitalists, those people who just give you money, or finance, or just do business. They will ask question. They give you their money now. They want to get return on their investments. Business angels under the sources of finance, SME. So exceptional items will be excluded because they do not occur regularly. If this company is a listed company, they will not have exceptional items because the shareholder, those who have shares in the company, they will ask question. You make a loss, meaning that you are not paying us. No. Oh yeah, now we want to see the income statement. They will start. What is exceptional items? Class, are we still together? Class, are we still together? So therefore, we can copy this and restructure the profit after tax.
Yeah, hello, please, IB, there's something I also want to ask concerning the dividend that they declare. Upon the loss that they have, they are still declaring dividend. Is it possible, sir?
No, I don't know. Interesting. So that is a very good question, right? You see, over the years, I think I have a privilege to analyze the company stuff, right? And I was like, I saw you God, you make, that's why I say accounting profit is you actually read. You gave a financial income statement that is profit after tax. Let me assume it is 15 naira. Then the total value of dividend paid, is like 100 naira. The question is, where did you see money? Who fund you? You have an income. We already know that the dividend will be paid from the income statement, from the profits. And you have 15 naira. You now pay dividend value of 100 naira. Okay, I wanna take you the 15 naira one I had. That is the reason why you should be very careful when you want to do what? When you want to buy shares. Wow. So it shows that this financials is not real. So you better run. No. You can't buy shares here. How? No, that is a very good question. And it is because it is unlisted company. You can't do this. The question is, you declare dividend. Yeah, now, how do you want to finance it? Do you get? So that's a very good question, right? Makes sense. So that is the question. How do they want to finance it? And you declare dividend, you make a loss. It's because it's an unlisted company. They can't find that in a listed company. You don't even declare dividend. Or they can even defy it. They can even declare it and defy it. Right? So we have to restructure this by excluding the exceptional items. So interest paid net, operating profits before exceptional items. This is it. Interest. So when you subtract 6,510, what do you have? Please subtract 6,510 minus 1,400, please. When this class starts exactly 3 p.m.
5,110.
5,000
110.
110. That is 010, right?
110.
Okay. So now tax. Please don't go and use this 1,015 naira. This 1,015 naira is calculated based on what they have in the previous, right? Based on the exceptional items inclusive, right? So therefore, the tax, what is the tax rate given to us in this question?
30%.
30%.
30%. So therefore, we can have 30%. What is the 30% of 5,110?
1,533.
1,533. So what will be the profits? Because now is now profit. What will be the profit?
3,577.
3,577. So this will be the profit after tax. Class. This will be the what? The profit after tax. There is no preference dividend in the question. No preference what? No preference dividend. So we divide it by the numbers of shares. So what is the numbers of shares? 40,000, right? 40,000 shares. 40,000 shares. So what will be the earnings per share? What will be the earnings per share, class?
0.08.
0.09.
0.09 per share. So therefore, you can see examiner. So okay, Mr. Max. $0.09 shares. The market price. The PE ratio. What is the PE? What is the PE ratio given to us in the question?
30:1.
Okay, 30:1. That is 30 divided by 1. That is what it means. 30 divided by 1. If it is 30:2, 30 divided by 2. 30:4, 30 divided by 4. Times the earnings per share. 0.09. That is why the examiner give that dividend. They know that that exceptional item will not be included. That's how come now you declare loss and you still have dividend? How? He knew that that exceptional item will not be included. You can see that when we restructure it, we have a profit. So they cannot pay dividend from this profit. So what do we have?
2.7.
Okay. 2.7. 2.7 naira per share. $2.7. So we are done with this question. We are done with PE ratio, 6 marks. Next, dividend-based valuation. Dividend-based. Dividend. Dividend-based valuation. So what happened to the dividend-based? Okay, let's check. So do we have dividend with goods? So dividend are expected. When they say dividend based, you should ask yourself, is it dividend with good or without good? Class. All you need to do is to check from the question. Are you giving dividend for the current year? Is there a growth in the dividend? There is. Dividends are expected to grow at the same rate as revenue. Class. And the revenue will go for 3 years. 2021, 2022, 2023. So dividend will grow by 25% and 10% thereafter. So we need to know, we need to determine the value, the present value of the dividend. We should not forget this. We did, I think we solved a similar question like this on the free cash, the first question we solved, right? So yeah, the cash flow, the DCF, the present value, 2021, 2022, 2023, 2024. Oh, for 3 years, sorry. 3 years, right, class? Shina, 3 years.
Yes, sir.
Okay. So I think it's in thousands, it's in million or thousand. Okay. What is the dividend given to us in this? Oh, items. Or should I just? Oh, we already know, Joe. Let's just put it. Okay. What is the dividend given to us in this question? Dividend, the current dividend, 1,000. Is that not so, class? Are we still together?
Yes, 1,000.
Yes, sir.
Okay, 1,000. So 1,000, and it will grow by 25%. Raised to power 1 in line with revenue, right? 1,000 times 1.25 raised to power 2 1,000 times 1.25 raised to power 3 raised to power 3 So what are we going to use to discount the dividend? Class.
12%.
Hello.
12%.
What is that 12%?
The
What is
estimated
the
cost of equity.
Cost of
The
equity.
cost of equity. Yes. Class. This is dividend. You use cost of equity to discount it, to know the present value, if it will go for grow in line with revenue. 12%. So what is the DCF? What do we have here?
0.93.
3 decimal. 0.93 what?
0.893.
893. Next.
0.797.
0.797.
797. 0.712.
0.712. So what do we have here? What is the present value? Don't forget that we have thereafter. Thereafter is infinity, right? What do we
893.
have?
893.
893. What do we have here?
1,245.
1,000.
245.
245.
245. What do we have here?
1,391.
1,391. Yes.
Sir, number one is 1,116. 116.
Yes.
116.
Yes,
Yes,
sir.
sir.
Yes, sir.
Okay. Thank you, Mr. Timothy. So, what do we have here? If you had the three together, what do you have?
3752.
3752. So this is the present value for 3 years. So, and they said 10% thereafter. That is infinity. To start from the last year. 3 to infinity, class. Please, how do we determine 3 to infinity? The last year, to start from the last year. Right? Then multiply. What is the growth rate for the year after? Oh, excuse me. What is the growth rate thereafter?
10%.
10%, class. 10%. Please, when you want to calculate infinity, this is the approach you use, please. Right? So 10%, 1.1 times, don't forget, present value 3 to infinity present value. Now, the next is to multiply by the last year DCF, which is this, times this, divided by cost of equity because you use cost of equity, dividend, it is dividend, right? So cost of equity So what is the cost of equity? 0.112 minus, minus the growth rate, 0.1. So what is the present value? The infinity. What is the present value? What do we have?
76,484.
76,484.
0.37 or 0.38.
7648 what?
484.38.
484, yeah, 484 is okay. So what is the market value? What is the market value? What is the value? What do we have?
8236.
8236. That is the value. So what is the market value per share? Market price. $80,236 divided by the numbers of shares. What do we have? What do we have here?
2.01.
2.01 per share. So we are done with dividend valuation. The next approach is on the present value of expected cash flow.
Please, sir, I want to ask that place where we calculated the infinity, how we derive that 1.1.
Kende, what is the growth rate thereafter? Sir.
Okay. Oh, okay.
Yeah.
I've seen it. Thanks a lot.
Yeah, I need to hear a voice. Hi, how are you?
She's fine.
All right. Thank you. I got Taufik. For me.
Okay, well done, sir. My question is, why do we use 1,000 times 1.25 raised per 3 in getting the infinity?
Yes, when you want to do infinity, it will start from which year? It will start from the last year. For me, it is from year 3 to infinity. And if you want to determine the infinity, you have to start from the last year to infinity. Do you understand? You can use this. You can pick this present value. If I want to do it, I can decide to say, I don't want to do that way. I just say, or I can just pick it. What is the present value? I'll pick this present value, right? And I'll multiply by the growth rate. Pick present value times the growth rate is 1.1 divided by 0.12 minus 0.1. I think we did this something like this under the free cash flow. Right? If I still use this approach, I'll still arrive at the same answer, right? Do you understand?
Okay, yes, thank you.
Yeah. So when you want to determine to infinity, it's just like you want to forecast for next year. You have to use the information of this year for next year, and that is what it means. You get?
Yes, I get it now. Thank you.
You're welcome. So,
Hello, sir. You're having two growth rates, one at the numerator, the other one at the denominator.
that is it.
But you're having 1.1 for up, then 0.1 for down.
That is it. That is the formula.
To add one.
You say?
But on the numerator.
Grow the first one, grow the numerator, grow it, leave the denominator like that. Cost of equity minus the growth rate given to you is 10%. What is the cost of equity? 0.12 minus the growth rate is 10%, 0.1. Just leave it like that. So it's the first one you grow. You want to grow figures now, not this thing.
Thank
You understand? You have to grow the figures, not the denominator. So please, we did something like this under free cash flow, and we'll continue to see something like this as we move. Even under the merger and acquisition, we'll see something like this. So please go and master it. The first one under the introduction to free cash flow is still the same thing, similar to this as well. Right. Thank you. So, lastly, before we go, the present value of expected future cash flow. You should not forget that this expected future cash flow is free cash flow to equity, because the DCF, they were given the cost of equity, meaning that when you are projecting for future cash flow, you have to use a free cash flow to equity to determine the future cash flow. In the previous question we solved, the net cash flow is given already, so we don't need to do projection. It is given to us. They projected it. And that is the reason why we didn't start with profit after tax, this, add back this, add back this, add back that. Because the question the examiner gave us, the net cash flow after what? After tax. Class. Okay. 258. Wow. Okay, let's just finish this question so we can go. Our present value determination. Present, okay. Determination of present value of future cash flow. It's for 3 years. It's for 3 years. Twenty 2022, 2023. So excuse me. So this is free cash flow plus determination of present value of future cash flow. Let me just use this cash flow. Then you state it here. Let's say this is free cash flow to equity. Okay, class. We start with profit after tax. You should not forget that we have restructured our profit after tax to be this. But then, let's quickly go back to the question. Okay. Operating profit before exceptional item is given 6,510. Is there any additional information we need to check? We have used this. this. Should I Okay, so we are here to use all these ones, right? So now the first item, we're supposed to have profit after tax. Then we had back none what? Oh, excuse me. Okay. Okay. So operating profit is expected to be approximately 8% of revenue in 2021. 8% of revenue in 2021 class. That will be the what? The operating profit. We are supposed to start with profit after tax, add back. But in this question, we're told that the operating profit will be how many percent of the revenue? Will be 8% of revenue. So we don't need to start from the profit after tax. We're given how we will grow the operating profits. So the operating profit, how many percent of revenue? 8%. Class. 8% of which revenue? 8% of which revenue times class. For you to get operating profit in 2021, it will be 8% of revenue. Now, 8% of which revenue class? 8% of what?
2020.
2020. Thank you. 2020. Right? 2020. 112 400. 112 400. Okay. Okay. What do we have? So what do we have?
8992.
8992. Right, and remain stable. The question says and to remain at the same percentage in the future, right? Operating profit is expected to be approximately 8% of revenue in 2021. And if it is 8% in 2021 and to remain at the same percentage in future years. So it will still remain 8%, right? So 8% of what in 2022?
899.
8992.
Thank you. 8992. So what is 8% of 8992? What do we have?
9711.
9711. Next.
$10,488.
10,000.
488.
10,488. Class, are we still together?
Yes.
Yes. Yes, sir.
Okay. So we can move, right? Now, after these profits, operating profits, class. How should they present this? This. Okay. So after this operating profits, Busta, can you meet your mind?
Average earning growth. We have not made use of it.
Yeah, there's nothing we want to use it for. They are just giving us the industry average.
Yeah,
wait. See, wait. They just give us the industry average. They just tell us that average earnings. Yes, it's for distraction.
Hey.
Average goods in
I would,
the
I would
industry.
have I would have used this 6% like 6 times or something before I know.
To do what? It is well. Okay. Now, after the operating profits, class, let's start. Okay. Away. It is free cash flow to equity, right? What is our formula? Let me check.
Sorry,
Okay.
sir. So I thought that revenue already had a growth of 25 already. So
Did
I
you?
noticed that the operating profit we just use like the figure, the 112,400. But in additional information one, they said it will grow by
Okay. I'm coming. Let me check. Just a minute. Let me check. If the acquisition succeed, there will be revenue synergy leading to an increase. Okay, in annual sales. Okay. Let's do it this way. Thank you so much. Okay, let's do this way. Sales. How many percent? 112,400. It will increase by 25%, right?
yes.
1.25
Yeah.
raised to power 1 in the first year. What do you have?
140,500.
142,500.
144.
140,500.
Okay. I agree. It's 1.25 raised to power 2. What do you have? Times
175,625.
1.
175,625.
175 to 650.
Okay. 112,400 times 1.25 raised to power 3. What do you have?
219,531. 219,531.
531. Okay, good. So, okay. Thanks for calling my attention to this additional information. Thank you so much. Right, makes sense. So it shows that. So what would be the 8% coming? What would be the 8%? 8% of revenue What do we have? What is the 8%?
11,240.
11,240.
11,240.
Yeah.
8% of 175.
Yeah, 14,050.
14,050.
14,050. 8% of 219. What do you have?
17,563.
17,563. Okay. Then someone want to ask question quickly, please. I need to go. This is 312. Wow. Okay, quickly, please.
Are you going for one?
Please repeat your question. Sorry.
No, sir. I said, are you going for one best, sir?
No, actually, I have something to attend to. It is well. So we have 8%. No one bet today.
or you want to go and watch my Chelsea?
I'm not going to talk about that one now. I'm a Chelsea fan now, so I have to watch that match.
I will beat you today.
Okay, they play. So we've grown the sales to be this class. Our operating profit to be this. Is that not so? Now let's quickly do something here again. Interesting. This is an interesting question, though. Now our non-cash, the working capital, interest. We should not forget that we want to determine profit after tax. When we determine profit after tax, we cannot add back our non-cash items. Is that not so, class? Now, class, after the profit after tax, what do we have? We don't need to include exceptional item. What do we have? We have interest net, right? The interest given to us as net is 1,400 in 2020, class. And the information says that, the examiner says that additional information 5, working capital, interest payment, and non-cash expenses are expected to increase at the same rate as revenue. And the revenue will increase by 25%, class. So therefore, the interest will increase by 25%, right? The interest of 1,400 will increase by 25%. Because if you want to determine the free cash flow to equity, you start with profit after tax. And that is the reason why you start from your sales, right? Then we were supposed to use the profit after tax, but examiner says no, we have to apply sales to increase by 1.25, 25%. Then the operating profit will be 8% of the sales. After that, in our income statement, we have interest. We deduct interest. If we deduct interest, we pay tax. That will give us profit after tax. When we have profit after tax, we add back non-cash item. We'll factor in the what? The capital, what is it called? The capital expenditure. Is that not so? Then the borrowing, if there is borrowing, right? We'll factor in what? How much they borrow in the year, class. So interest net. What is the interest net given to us? What in 2020? What is the figure?
1,400. Putting the interest again.
1,400 times. What is the growth rate? 25%, right?
25%, yes.
1.25 raised to power 1 for the first year. What do you have?
1,750.
1,750.
750 raised to power 2. What do you have?
2,188.
2,188.
Thank you. What do we have here? Raised to power 3.
2,735.
735. Class.
734, sir.
734. 734.
Okay. Class. After the interest and expenses, what do we have? Is the profit before tax. Then we apply tax before we arrive at profit after tax. Is that not so? So, profit before tax. Please mute your mic. Profit before tax. Can you mute your mic? All right. What do we have? The difference.
9,490.
9,000.
490.
490. What do we have here?
11,863.
11,862.
62.
862.
What do we have here?
14,829.
Okay. Tax. How many percent is the tax rate?
30%.
So what is the 30%?
2847.
2847. What do we have here?
3,559.
3,559. What do we have?
4,449.
4449.
Okay. So we want to start our free cash flow to the firm now, to equity, sorry. So when you subtract this, you have your profit after tax. Profits after tax. What do we have? What is the profit after tax?
6643.
6643.
6643.
8303.
8303.
8303.
03.
10,380.
10380.
10380. Please, when you are faced with this kind of question, you have to be very careful, right?
Yes, sir.
What we want to do is there's some information that is not even relevant. Like I said, when you are faced with any question, what you need to do is, what are the ingredients? What are the things you will use? The principle behind it. Then ignore the story and all that. Check, oh, you need this. You need this. Remove it from the question. Right? Like that average something. It's not needed. We don't need it. And what do we want to use it for? It has no use in this question. So we are starting the profit, free cash flow to equity. Profit after tax, after profit after tax. Right? We add back. Because it is equity, do we normally have interest?
No, sir.
So what are we in our formats? My body don't come up for this class. Let's see. Okay. Okay. Depreciation, we had back all other non-cash items because where is this question now? Oh, okay. Okay, because we have to pay interest order, right? So we don't need to add back up interest. So which other non-cash item from the question? Non-cash items. Let's check.
Depreciation.
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 Thank you. Now, we should not forget that non-current. Okay, we'll use this. Right. So non-cash expenses include depreciation were 4,100,000 in 2020. So how do we get the one of 2021 now? How do we get it? But it was stated. Where is it? Where is it? Where is it? Where is it? Where is it now? Oh, hey. Working capital, interest payments, non-cash expenses are expected to increase at the same rate of revenue. We've done this. We've done this. Now, non-cash expenses increase in line with 25% of revenue. Don't forget we have thereafter. When we are done with that one, we'll do thereafter. So, class. So, meaning that this will grow by 25%. Of course, if you start from, you have to use information of 2020 to grow it to what? To 2020, what? To 2023. 4.1. Depreciation. Uh, 1.25 raised to power 1. What do you have here?
5,125.
5,000.
125.
125. What do we have here?
6,406.
Okay, we already put 00 up. So 6,000.
406.
406. What do we have here?
8,008.
8,008. Class. There is no amortization. If there is, we don't have a loss on disposal. We have profit, we subtract it. The non-cash item. Right? The next thing we need to move from our free cash flow. Please, someone we have to, okay, now before on Monday now, yes, on Monday. Please prepare yourself. Fumi, Bashirat, Fatai. Please, you will explain what is it called? Free cash flow to equity. The format, you explain it to us. Maybe you just use like 10 minutes to explain the format. Fumi, Bashirat, and Fatai.
Me too.
Thank you. So, non-cash items, we have this. After the non-cash items, we have capital expenditure. Is that not so, class? Capital expenditure or non-current assets. So what happened to capital expenditure? We grew by how many percent? Capital expenditure was this in 2020, and it is expected to grow approximately the same rate of revenue. Can you see it, class? So we grow this.
And that Mr. IB,
In that non-capital expenditure, why did we not go through the route of it from the amount it was in 2020 this and then removing the depreciation the way
What?
you did it last time?
I don't understand.
The last time when we treated non-capital expenditure. Yes, sir.
No. They didn't give us that one. That is the reason why they say it will grow. So if it is growing, it will reduce the cash flow now. Is that not so?
Yes.
To reduce the cash flow. So we will not go through that pattern.
Okay, thank you, sir.
Yeah, you're welcome. Because it will grow. If it is growing, it will reduce the cash flow. Is that not so? It will reduce the cash flow. For me.
Okay, please, I don't get like capital expenditure under non-cash item.
No, we are done with non-cash item. Maybe we are done.
Okay.
We are done with non-cash item. Now is capital expenditure, working capital, and borrowing. Is that not so?
Okay. It's the way we put it together. I was scared.
Okay. We are done with non-cash this thing. Now is CapEx, capital expenditure, non-current assets. So is 5 million, right? Times 1.25.
6,250.
6,250. 250. So what do we have here?
7,813.
7,813. Okay, we reduce the cash flow.
Then the last one.
Coming, just hold on, please. So what do we have here?
9766.
9766. Okay. Plus. After this, we have working capital. Right? So, and we're told that the working capital is also working capital, interest payments, and non-cash expenses are expected to increase at the same rate as revenue. So now working capital. So we need to determine the working capital. So we'll go back to the question. Current assets, total assets. Okay, current assets minus current liability, right? Exclude what? Exclude cash. Current asset, exclude cash. Current liability, exclude short-term what? Short-term deposits or short-term debt. Class, are we still together? So we have to okay. Current assets. I think I've done something like this before. I can just copy. No, I need the original book value. Okay, let me just copy the original book value. Exclude this. Okay. Current assets. Okay, workings. Inventory 7,000. This one is not revalued though. This is working capital, right? So the current liability what is the current liability that is payable? Please, what is the figure? What is
27,600.
27,600. So what will be our working capital? What is
So I
working
thought
capital?
it's cash and cash equivalent that is excluded from working capital, and this one carried cash and bank.
What is cash and bank? What is cash and cash equivalent, and what is cash and bank?
Oh, na shame. Oh, na shame.
Whether it is whether it is cash and cash or whether it is cash and cash equivalent, it is cash, right? Excluded, please. Thank you. Thank you. So what is it? What do we have? The difference?
3190.
3,190.
Okay. So we have to grow it in line with, please mute your mic, or working capital. Oh, working capital. Oh, what is the working capital? 3,190 times 1.25. Raised to power 1, what do you have? What is the increase? What is the increase? You can see that in this question, they just give us how it will increase on year basis, right? So what do we have, class?
3,988.
988. What do we have?
4,984.
1,000. 1,000.
4,000.
4,000.
984. Okay. Raised to power 3.
Elisa, I hope that inventory, that 17,000 is not realizable value.
What's that?
That inventory.
No, it's not realizable value. Let's check.
Okay, fine.
No, it's not. It's the original.
Thank you, sir.
Yeah.
6,230.
6,230. You can see that another method of growing our working capital is given that it will increase. So it will reduce the cash flow. The capital expenditure is given that it will increase. It will reduce the cash flow. Class. You can see the question, the examiner can come in two ways. Maybe you have to compare 2 years or just give you the growth rate. So when you grow it, it means that it will reduce your cash flow, right? Do we have any borrowing? Did they borrow any money? Do we have any borrowing loan or anything? Do we have?
Let's check the question.
Okay. Any loan? Any loan?
No, sir.
Okay. Thank you. Okay, thank you. So we are done. Okay. We'll have to discount, but before we discount, so what do we have here? Sorry, I'm coming. Let me check if we need to bring in something. Okay. Done. Okay. I think we are done with this part as well. Okay, what do we have?
$1,530. 1,530.
1,530. What do we have here?
1913.
1913. What do we have here?
2391.
2392. Anyone?
2392.
Anyone? Now one naira. Rabi? Oh. So we have to discount, although it's material, though. 1 naira is also material. by 12%. What do you have? 0 point what? Come on, let me copy this.
0.893.
Okay, next.
0.797.
0.797.
0.79797. What do we have?
0.712.
0.712.
712.
0.7. Okay. 0.712. Okay. So, this question long ago. Present value.
1,366.
1,366. What do we have here?
Is UI 1524.6.
One what?
4.7.
What do we have?
1524.7.
Approximate is 1525.
1525.
Okay, what do we have here? Wow.
1703.
1703. 1703. Okay. What would be the free cash flow? Free free cash flow
To equity.
To equity from which year to which year?
2021.
2021 to 2021 to 2023. Is addition of the three. What they have? Oh, no need. No, there's no need. Don't worry. We don't even need this one. Let's should we need it, sir? I don't even know. This is 136 1525 170. Do we need this? Do we need it? Okay, yes. Okay, what do we have? I think we need it. What do we have?
4594.
Okay. Four, 594. Okay, thank you. Now, to infinity. Suppose leave this part too. But let's just do it together, right? 2023 to infinity. Right? The present value. Class. And it will go by 10%, right? Are we there? By 10%. Now, the question now is the last free cash flow. FCFE. Class. There are two approaches. So the last cash flow, when you want to do to infinity, class, when you want to do to infinity, there are two approaches to this question. Don't forget that, right? There are two approaches. I can use up and down. So let's use the second one, the second approach, right? Just like this. Where is it? Just like this approach, or 1039 times 1.1. I will use that method. Yes. So the infinity will start from the last year. If you want to grow it, it will start from 2023. And what is the present value for 2023? 1073 times The growth rate, how many percent? 10%, right? 10% grow. Is that not so?
10%. 10%.
1.1. I don't need to multiply by the DCF because I've already determined the present value already. All right. Divided by the cost of equity minus the growth rates. What do we have?
93665.
Okay. Nine 3665. Eh? Is it 93665? Okay. Oh, 93665. Yes, it should be because of the growth rates. Please, others should confirm. So
Yes, it's correct.
Correct.
What will be the market value? What will be the market value?
98259.
98259. See what we define since so. Hi, God. Just 98259. Oh. So you can use the other approach, right? You can use this, right? This is the free cash flow before the DCF. Make use of this. That one will be too complicated. Make use of this.
This one is
Yeah.
simple.
Yes, now it's still the same thing. Like this. Present
It's the
value.
same thing,
This one
just
is
that
better.
there is slight
It's better.
differences in the
Did not get
figure.
the same amount.
In fact, you really simplified it.
There will be a slight difference in the amount.
There will be a slight difference.
Yes.
When? In this one, this one, this or this one? Check your
In
calculator.
between the two methods.
No. Okay, yes. Maybe I don't think so. Yes,
Rounding
as well. Yes. But it's still the same thing. Right? It's still the same thing. So you can use it to determine the market price. Just divide it by the numbers of shares. So you have the distinguished professional colleagues. I think I've been able to do justice to some of these valuation questions. We are just starting, right? We've not done anything under valuation because I need to introduce share to share as well as the merger, right? So thank you so much, everyone. Do you have anyone that have question, please? Do you have question?
Sorry. Just ask. So anywhere we see present cash flow, it means that we have to determine the free cash flow.
Yes, free cash flow. Yes, either free cash flow to the firm or to equity.
Okay. Thank you.
You're welcome. Depend on the question, the examiner, what is it called? The question given, you can see in this question, they just give us cost of equity. So that shows that you have to determine free cash flow to equity. But in another case scenario, they will give weighted average cost of capital.
Right. Check for debt. Okay.
Yeah, that means it includes what? It includes what? Debt, not equity and debt. That will be free cash flow to the firm. Is that not so?
Yes, sir.
So thank you so much, everyone, for joining. Enjoy the rest of your day, right?
Thank you, sir.
Thank you.
Thank you very much, Mr. Ibrahim.
Thank you. Where is our energy drink? Hello.
Enjoy your match, Mr. Ibrahim.
I've dropped it too.
You've dropped it, Abby.
Mr. Ibrahim,
Your doorstep.
Mr. Ibrahim may not enjoy it because I will beat him.
Okay. Yeah, now. No worries. All right. Thank you, everyone.